afternoon. Welcome to our guests. What a beautiful turnout. And I know it's a bit gloomy, but we're going to have some fun in here. Welcome to our Landlord Lunch Learn. For those who do not know me, my name is Mary, and I am from Southern California apartment group, Shant Sherbetdjian's office. You know, the last time we did this was over a decade ago, 2012 to be exact. Why are we bringing this back? Well, there has been, I would have to say, within the last 5 years, our dear landlords have been on one heck of a roller coaster ride. I would have to say, maybe since COVID, landlord apartment ownership world has changed drastically. You're getting familiar with the one law and a new one comes out. City council member meetings once a month, red alerts here and there. It's almost impossible to keep up with this stuff. I can see the frustration. I can certainly hear the stress over the phone. And this is why we provided you with stress balls, by the way. Yeah. Next time you call the city office, be sure to have this handy. They actually really do work, okay? Yeah, this is a bit frustrating for us. So another thing that we've noticed is the last couple of years, our office has become some sort of an informational hub for a lot of our clients. Our existing clients that we've sold buildings to 10, well over 15 years ago, were just recently calling us asking for help. And we're happy to do so. We're in this every day. We see what happens. We're in the trenches. We love to provide information. But one thing I've noticed amongst all of our landlords across the board is these questions that you're asking is very similar, except different scenarios. And I was like, Shant, I think we need to bring back our Landlords Lunch Learn. Let's provide a community of well-informed landlords who are educated, because ultimately, this is what you need to stay ahead of this curve. And we're happy to give back. So what are we going to expect today? Today, I've got an expert guest speaker panelist lined up for you all. These 8 individuals are dealing with landlords on a day-to-day basis in every aspect of apartment ownership. So they're going to talk to you about what the climate is like in their department. What are these things that you should be looking out for? What are we going to do? We're going to cut through the noise, provide practical insight, and I want you to leave here with some clarity. Now, most of this stuff you already know, right? Some of this stuff you may not have known, and you're so happy you came, and I'd love to hear that. But really, the idea is for you to walk away here with some clarity, enjoy some good food, and some good company. So we're ready to get into it, and I'm excited for this. Now, some housekeeping rules before we get started. You guys were given some informational booklets. Please use this. This is some great information inside. And with that, you were given a question card. Now, you may not have a question now, or you do have a question. Please complete this question. Hold it up. I will come by and pick it up. I'd be happy to ask this question for you to our panelists. Towards the end, they will all be joining us up here, and we'll have an active Q&A session. If you don't want to do that, no worries. These question cards are nameless, by the way. I can pass around the microphone during that hour, and you're welcome to go in and ask the question to them directly. In addition, we have what's called a guest feedback survey. If you can, this will help us because we do plan on doing a lot of these. And if we can perfect it somehow, I'd love to hear your thoughts. These are also nameless, so if you can, fill that out. On your way out, when you see towards the exit, there's a feedback survey bin. Just go ahead and toss it in there. My team and I will review it. We'd love your feedback. It would be greatly appreciated. So, we're about to get into this. I am excited to introduce our first speaker and the host of this afternoon, Shant Sherbetdjian.
Everyone. And Thank you for joining us this afternoon. First and foremost, I wanted to say thank you to my two assistants, Hannah and Gianni. Gianni, I think she's still checking some people in, and Hannah has moved to the check-in as well, so thank you very much to them. And then also to my MC, which is actually my wife, and she is a real superwoman. She's done so much work. Mary, thank you very much. The tireless hours are very appreciated, so thank you. All right, let's get down and dirty. Here we go. The two questions that we get asked the most, probably on a daily basis, are one, how much can I raise my rent? And secondly, what is the market like? So let's get into it. We have created it's basically somewhat like a cheat sheet for the rent control increased amounts that we can raise. So if you look inside your book in the first section, you're going to see a chart. Now this chart was put together the beginning of February, and you can see this is predominantly the areas, not in the city of LA, because the city of LA is typically 4% for the most part, but this is all the other areas that are surrounding the city of LA. So when we look at it, you'll see the city, and then you'll see the increased amount next to it, and then obviously the some notes as far as the increases are concerned. Everything is fairly self-explanatory until we get to some of the unincorporated areas. This is where things get a little bit trickier and some extra explanation is due. Here we go. Okay, so not sure if many of you know, but there's many unincorporated pockets in the county of Los Angeles. There's some here in Arcadia, there's some in Whittier. Montrose is actually unincorporated as well. So essentially, this is where we've seen the most questions asked to us regarding the amounts that we can increase the rents. So up until the end of last year, well, actually first let's take a step back. First, you need to see if you're a general landlord or if you're a small property landlord. A general landlord is anyone that owns more than 10 units collectively, or their property is in an LLC. If you are a general landlord, you are considered the highest tier in the unincorporated program. The second one is a small property landlord, and that's if you own less than 10 units in your personal name. This is why it makes a difference. And let's just speak on terms of general landlords. Most of you here, if you own in these areas, that's probably the jurisdiction you're in. Up until the end of last year, you could raise the rents 4% annually. Starting January 1st through the end of June, the rent increase amount was lowered to 2.565. And then starting July 1st, for another 12 calendar months, up until the end of June, it decreases to 1.93%. So it's very complicated. If you've owned a building in these areas, there was never any rent control before. So many of the people that are calling into us, they get so frustrated. I had someone that I've known for years. He gave a 4% increase starting in January, and a really nice man, owns a couple buildings in unincorporated pockets. He was extremely frustrated because he said, what am I supposed to do now? I just gave a 4% increase at the beginning of January. Am I supposed to go rescind it? Or what do I have to do? It's confusing. And if you look at the chart, and this chart was taken directly from the website of the LA County Board of Supervisors. So also, to make another note on this, we are in the process of putting a page on our website, our designer's working on it, where we're gonna have these numbers on these rental charts updated monthly. So at the beginning of the month, we're going to go through and double check all of these rental rates. So if you have any questions, what you can do as far as your rents, all you need to do is get on our website, check it out, and we're also going to have a link there which will take you to the exact place in the city just so that you could verify the rents. Okay, and the reason this is important was we had a building that we just sold. It was a 14-unit building in Montrose. This building was beautiful. It was built in 1984. We sold it for the original builder. This building is a few blocks from La Cañada. It's right off of Ocean View and the 210 freeway. Majority of the buyers and the agents that work this area had no idea about this rent control. But it's a big deal. Everywhere around there is 8.9%. And if you buy this building, you're at 2.565%. So if you bought a building with a compressed cap rate, you're not gonna be able to make any money. So it's something that every buyer should know and the agents should be privy of. All right. On to the next point. Tighter cap rate. Okay, so let's get into the next points. This booklet that we gave you, from the middle to the end of this booklet, you're going to see many charts in blue and black charts. What we've done is, majority of the areas that everyone here owns in, we've taken the historical data from 2020 to 2024, end of year 2024. The data is comprised of 5 to 50 unit complexes up until the age of 1995 construction. The only two cities are Burbank and Glendale, which have two sections, two separate sections, and I'll get into that in a second. Burbank and Glendale, we separated them for units built up to 1980, and then from 1981 to 1995. There's a large amount of 80s constructed properties in Burbank and Glendale, and it's really two markets within one market. So there's an important distinction here, and you could see that inside when you take a look at it. Also, at the end of the book, you're going to find a loose leaf sheet. This is for Pasadena. So it's the last page inside the book, and it's loose leaf. So what we've done here, and just to go back to Pasadena in the Tri-City markets is one of the most desirable pockets that you can own in. Between Glendale, Burbank, and Pasadena's always been a little bit of the jewel of the Tri-City market. But if we take a look at the charts that are here, we could see where Measure H, which is the Pasadena rent control, when it was enacted, it was voted in December of 2022. So if we look at the data, you could see where the average multiplier in Pasadena at that time, in 2022, it doesn't even seem real anymore, 17.98 over 30 deals. The average multiplier was 17.98, which is a very high multiplier. The next year, right after the rent control came in, and the rent control in Pasadena currently is 3%, the multiplier went down to 14.38. And then after that, in 2024, 13.32. So it's very important to understand how the rent control will impact the markets. Okay, on to the next. As many of you know, if I've spoken to you, I'm sure I've mentioned it, that I'm going to be running the LA Marathon in less than 2 weeks. So it's something we've been working quite a bit for. I'm a big guy, so it's a lot of work to get this body running that many miles. So when I was running one of the days, I was trying to think about an analogy between apartment ownership and running. It's all like a race. So when we take a look at it, the flat 5K was what we had 20 years ago. There were no major rent regulations, except for LA City. We had the freedom to strategize as far as what we could do, get into a building. I mean, we sold many buildings where people were going in, giving 60-day notices to tenants, using the, not renovation, but you could basically get someone out in 60 days. But obviously, some of those things might have been misused to lead us to where we're at today. The main risks we had at that time were non-paying tenants and general building maintenance. But the interesting part was the buyer profile, how it's changed over the years. Before, I felt the business was very novice from the standpoint I used to sit in kitchen tables with blue-collar people that would have $500,000-$600,000 and they wanted to go buy an 8-10 unit building. That doesn't really happen anymore. I'm in the trenches. I see the people that I'm dealing with. And majority of the buyers now are professional buyers that do this full-time. Now we're in the middle of the hills. We have regulations that have started. There's more tenant protections. And I wasn't a full believer in this. Actually, one of my clients here, his name is Raul. Back in 2018, he called me. My office was in downtown. And he said, LA County Board of Supervisors is going to meet and they're going to pass rent control. I said, there's no way it's going to happen. He said, let's go, let's meet over there. So we took the afternoon, I went over there. When I walked into that place, I saw what I would never expect. There were 100 people in a line. Each of them allotted 2 minutes to go and talk about these rent increases that they were getting bestowed upon them. So anyhow, we sat there. I actually heard names from buildings that I had sold in unincorporated areas. The people were talking. So it was a little bit of a surprise. But when we went outside, there was a lady that was getting interviewed from the Spanish station Telemundo. I don't speak Spanish, but the person I was with spoke Spanish. And after she got interviewed, we went up to her and he asked, "What happened with you?" She said, "They raised my rent by 500%. So you hear 500%, it throws my ears back. It's a big number. So we went and we spoke to her a little bit more. Her rent went from $190 on a 2-bedroom to $950. But when you hear it right off, it just sounds like such a large number that, oh my God, these landlords are the worst people in the world for doing something like that. And she's not grateful for the person that had a rent at $190 for all those years. Well, so what does this mean? Now we have other cities that are starting to adopt the same type of laws. We're having a trickle-down effect. And what's happening is, once these unincorporated areas, in my opinion, had this rent control that was enacted, right in the beginning of 2020, we had AB 1482. And if you look at that rent control chart, and I show this chart to you in 1 year, I doubt you're going to see less increase. Well, you're going to see more advantageous increases. Everything is going to be tighter. And we're seeing this trickle-down effect slowly coming through. One of the cities, the rent control there is 4% or 50% of CPI, whichever is less. That's catching a falling knife at that point. So some of the issues that we have are some of the rent increases. They're lagging behind the rising costs of insurance and all these new state regulations that we're having. All of a sudden now we have seismic issues. We have SB 721, balcony inspections. Not sure if anyone here has gone through and started those. They extended it from 2025 to 2026. So these are all things that we're dealing with. So what are we supposed to do? From a landlord's perspective, it's extremely important now. You need to stay on top of your rents. You need to stay on top of your tenants. Make sure you don't have any people that are living in the building that aren't on the lease. It's extremely important. We see it a lot. I was just chatting with someone earlier how someone had moved into the building or into the unit that wasn't on the lease, and the main tenant left, and now that person has established tenancy there, and they were never anywhere on the paperwork. So these are problems that we have to be on top of. And obviously with all this issue with insurance, which Gino will get into, is being extremely proactive on the maintenance of the building. But the funny part is, even with all of this said, all this noise in the apartment world, the values and the demand is still undeniably strong. We're selling buildings with multiple offers. A lot of people are still looking at it. Southern California real estate overall is hot. So there is a correction happening right now, but overall, we're still in a very good spot. So I will let the Gianni come up right now, and thank you very much.
All right. Forgive me, I was so excited to introduce my husband on stage. I just casually invited him up, but you know he does have a title. And I had written something beautiful for him, but I'm going to read it to you. Shant Sherbetdjian is a leading commercial real estate expert in Southern California, specializing in apartment sales. He began his real estate career in 2005 at Marcus & Millichap before joining RE/MAX Commercial Investment Realty in 2007. With over $500 million in closed transactions, Shant has built a reputation for his hands-on approach, deep market knowledge, and commitment to his clients' success. Please, one more time, a round of applause for Shant and the host of this afternoon. Now, our next speaker, Javier Serna. Javier, navigating the world of multifamily financing can be complex, but our next speaker makes it look easy. Javier Serna has over 15 years of banking experience working with owners of multifamily properties across Southern California. With organizations totaling over $3 billion. He represents Chase, the nation's largest apartment lender. Let's welcome Javier to the stage.
Good afternoon, everyone. How's everyone doing? Enjoying your early lunch or salads? All good. So my name is Javier Serna. I am an apartment lender based out here locally in Pasadena, working on your purchase financing or working on your financing needs if you currently have a loan. My locations spread as far east as the Inland Empire, down south to San Diego, and as far north as the Bay Area and anywhere in between. You know, my ability to provide you with competitive products and services starts at the very top. It starts with the brand, with the JP Morgan brand. If some of you are familiar with our CEO, Jamie Dimon, he's often coined a phrase of having a fortress balance sheet. And what that means is that no matter the economic cycle, the ebbs and flows, the volatility that we're in, you can count on us as your bank to be your financial partner through any aspect of the market. Anecdotally, you know, we saw that back in 2008, 2009 during the Great Recession when, you know, we acquired the fifth largest investment bank in Bear Stearns, and we acquired Washington Mutual, which to this date has been the largest bank failure in the nation, and we were able to swoop them in and take over. Most recently, in 2023, during the liquidity crisis, you know, we acquired the second largest bank failure in First Republic. So what that means for you as an apartment owner is that you have the financial backing of a partner that's committed to you through all cycles of the business. Now, on a more granular level, more local level, myself and my team, which is comprised of 3 other individuals, you know, we strive to provide you with the white glove concierge service through and through. That starts on the very first day when you reach out to me and you ask me about different loan and financing options. And that extends beyond closing of the loan, right? If a year from now, 2 years from now, after we've closed, if you've got a question, if you've got a need that for some reason you can't get through to my back office, I implore my clients to always reach out to myself and my team because we want to continue to provide that white glove concierge service to you. Now, in between that first day and years later, you know, my team is dedicated through the loan process to make this as an easiest process for you with minimal paperwork, minimal cost, and again, leveraging the brand to provide you with a competitive interest rate. Now, what does that mean? That means that for all of my loans, or 95% of my loans, I'm only going to require 4 documents. I'm going to require the rent roll, the operating history, your liquidity statements, and if you have the property in an LLC or into a trust or whatever entity it is, I'll need the entity documents. But those are the 4 documents. I don't want to see tax returns. I don't want to see W-2s. I don't want to complicate your life. I don't want to complicate my life. And again, that's our value add to you, is that we provide a streamlined process where we can get you a loan done in as little as 20, 25 days. I've seen it happen, but typically, you know, 30 to 35 days is going to be, you know, the time that we need. If we need to extend that out to 60, 90 days, 120 days, if you have a 1031, we can do that. So at the end of the day, I always tell my clients, I work as fast as you want me to work, or I work as slow as you want me to work. Whatever it is, we're here for you. And again, we want to provide that service. Going back to what Shant was saying, kind of giving you guys a little bit more info as to what the lending environment is right now. If you guys recall, or you guys are probably familiar with loans, they're typically 3, 5, 7-year terms. If you think about what was going on 5 years ago, we were probably in quarantine, fighting for toilet paper at the local Costco, right? But from a lending standpoint, you know, money was flowing freely. Interest rates were 3%, 275, 299. Capital was available. Now you fast forward 5 years later, that paradigm has shifted a completely 180 degrees. Interest rates are hovering at about 6%, maybe in the high 5s, right? So that's still close to 100% of what it was 5 years ago. As Sean alluded to, you've got rent controls, you got ordinances, you got eviction moratoriums, you got inflation. You've got a lot, that's been handed to you as an investor, right? And the situation is coming around, and fortunately for me, fortunately for the products and services that we provide, we've been able to so far come out where I would say 95% of my clients are refinancing, pretty standard with some cash out, very minimal, but some cash out. The other 3-4% are flat. I'm just going to be able to cover your costs, and you're going to get into a new fixed loan. And there's the one-off, right? The one-off where there is going to be some cash in that's going to be required, and we'll probably start seeing that a little bit more as we go into 2026 and 2027. But being able to have a financial partner like myself to provide consultative services allows you to give me a call. I was just literally talking to one of my good friends, one of my clients, and he reaches out to me, several times throughout the year, and he gives me a call and he says, "Hey, can you look at my rent roll? I've got loans that are due in 2, 3, 4 years, but can you look at them for me and tell me where my loans stand out today?" And I provided that service to him, and I've said, "Hey, look, this is where you're at today. If everything stays the same, these are the metrics you need to get to from a rent standpoint. This is kind of where things need to lie." And I'm very optimistic for you that I think in a couple of years when those loans come around, we'll be able to provide you some good news. I just recently had a client. He had 2 properties, one in Pasadena, one out in the Inland Empire. As you can probably guess, the property in Pasadena required a little bit of cash out or cash in. The property out in the Inland Empire, he was able to take some money out, and he was able to dig from his right pocket to dig into his left pocket and pay that off. And we were actually able to preserve some of his cash flow by putting him into an interest-only loan, right? So we do have, like I said, we have a suite of products and services that whatever type of ethos you have towards investing, we can try to customize it to your liking. But again, my number one priority is just to earn your guys' trust, and hopefully you look at me as a financial advisor that you can trust, that's going to provide you services in and out through the cycle, whether you need something done in 30 days or whether you're looking a couple years from now to purchase your first apartment building. We have the experience within our team where we've helped first-time buyers that Shant has sent us over and says, "Hey, they're buying their first 5-unit. Can you help them out?" Absolutely. To the larger investor group that's owns thousands of units and they've done hundreds of refinances. Loan sizes as small as $250,000 all the way up to $15, $25 million. Again, that brand of Chase provides that leverage that we can then provide to you. And then on a more granular scale, you have my team that's dedicated to providing you the white glove customer service. So looking forward to the Q&A, looking forward to meeting some of you at the post-reception. Hope you guys enjoy your lunch. Thank you.
Thank you, Javier. Our next speaker is an expert in securing the right financing for commercial real estate investors. Gianni Novo is a senior vice president at CBRE Capital Markets, Debt and Structured Finance team in Los Angeles. He founded Novo Capital Partners in 2014, growing into one of Southern California's leading commercial mortgage firms, securing over $1 billion in loans nationwide. Previously, the top producing loan organizer at Silverhead Capital in New York, Gianni now leverages CBRE's platform to provide seamless financing solutions. Let's give it up for Gianni Novo.
Testing. Thank you, Shant. Thank you, Mary and team, for having us, and thank you guys for joining. And I look forward to chatting with you afterwards in the Q&A section, also Q&A time also. 1 second. Can you scroll to the second slide? This, second page. There you go. Okay. Oh, you passed. Okay, we'll get started. So I'm a senior vice president at CBRE, the world's largest real estate company. I run a team that focuses on providing comprehensive services in the debt and structured finance world. So some of those services, just to highlight, involve land and pre-development loans, ground-up construction loans, bridge and value-add loans, stabilized and transitional multifamily loans, net lease retail loans, industrial hospitality, office, and special use properties. CBRE is one of the nation's largest agency lenders, so we are a direct lender on Fannie Mae and Freddie Mac programs. And then we have some specialty products like HUD financing and more nuanced stuff like that. So first I'd like to start with a common question that our clients ask us. How did we get into this high interest rate environment that we're in now? So I'll just sum it up in some key points here. So after the financial crisis in 2008, the central banks, including the Fed, they lowered rates to near zero, and that was for the purposes of stimulating the economy stimulating the economy and promoting growth. The second thing they did was quantitative easing, and that's just the act of government buying government securities, mortgage-backed securities, to inject more liquidity into the marketplace and to artificially keep rates low. Once the economy started to recover, employment rates and spending improved, creating a more inflationary environment. And then once COVID happened, some money printing, government money printing started. And then after that, there was a pretty stark shift in monetary policy. And I remember this all began in 2022, specifically around September and August, when interest rates started to reverse and go up. And then obviously there's global economic factors too that create short-term volatility with all the headlines that you hear in the news. So the next thing I want to talk about is today's underwriting challenges. So obviously we were in a very favorable interest rate market in the low threes, and all of a sudden the interest rates go up to 6 to 7% in some cases. So that's a problem because the NOI, the net operating income these properties generate, multifamily properties are generating, they're not keeping up with expenses and with rental increases and some of the things that Shant spoke about. Insurance is also, major. We're going to have an insurance specialist speak. That's a major expense that sometimes is going up 2, 3, or 4-fold. So that's shocking your net operating income also. Cap rates have increased. Lower loan amounts often are not enough to replace the balances that are owed. So those are cash-in refinances, which have been occurring frequently for the past year or two. Just to give you an example, in 2020, when our investors and our clients were securing 5-year fixed loans, those loans are coming due now. And those are more challenging loans to facilitate a cash-neutral refinance. Clients that made 7-year fixed loans back during the COVID times, you've got a little more time on those, and those are looking a little better. So how are we helping clients navigate in this complicated market? We are providing comprehensive portfolio level advisory to a lot of our clients. So we don't just look at one transaction. Oftentimes we're looking at the client's entire portfolio and making recommendations, and if they want our opinions, we give opinions as well. Sometimes we're rebalancing the debt and we're leveraging existing assets to, pull money out of this property and bring it over to this property and kind of stabilize the portfolio and give some of our clients more time to improve a property or whatever the case may be that the client might be working on. We also pride ourselves on professional deal execution. So we kind of look at ourselves as a kind of an outsourced finance team, a CFO, if you will, for a client's portfolio, especially for clients that own, many assets. We don't just forward documents to a lender. We kind of filter things through, give recommendations. The key is always to provide the most professional representation of the asset that we're looking to refinance or in some cases make an acquisition loan on. We also like to put ourselves in the landlord's shoes and give unbiased advice. That way our interests are aligned with our clients. I'd like to make a good point. The way that lenders underwrite deals is not uniform. There's a lot of subjectivity involved oftentimes. In this market, are pretty much fighting for every dollar of NOI to achieve the highest loans possible because of all of the challenges that I mentioned. A lender that underwrites with a 1.15 DCR versus a 120 or a 125 can make a very dramatic difference in loan proceeds that are available. And again, we check every single document before it goes to the lender. We act as a line of defense before we secure financing or submitting things to a lender. And that's the level of detail, frankly, in challenging markets that we need to have to make sure that deals don't fall apart, to make sure that if we can help a client not inject more equity into a deal, we've got to go above and beyond to make, ensure those things happen. I think a point that a lot of real estate investors, I get asked frequently, should become familiar with, if you're not already, is the DCR calculation. A DCR calculation, just to get granular, is basically your NOI divided by your annual debt service. NOI, there's a little bit of subjectivity in how an owner arrives to net operating income versus a lender, and representing the highest NOI that will pass a lender's underwriting and a lender's guidelines and also be corroborated by an appraisal is super important these days. The annual debt service it's a more objective input into that calculation. So DCR, it's something that landlords need to be hyper-focused on, especially if you know that you've got loans that are coming up and you really want to focus on representing the best NOI that your property has. Other recommendations that I can make, just sitting in my shoes, things that we see every day. If you're preparing for financing a property soon, make sure your financials, are as clean as possible, easy to understand. Try to get your expenses, as low as possible, reasonably possible. Make sure if you have capital expenditures on buildings that you're placing that below the line or you're calling those out specifically on your financial statements. And just things that you can control. Landlords have to face a lot of challenges these days, making sure your property has good curb appeal, there's no deferred maintenance, and multifamily these days is a very proactive, you've got to be a proactive owner. It's hard for multifamily to just be a passive investment, to buy a property and forget about it. I feel like those days are gone now. Let's see. The good news is there's no shortage of multifamily lenders in the business. So we've got, Chase that presented before, Javier, they're a fantastic bank. Oftentimes we tell clients, just stick with Chase. Sometimes clients want second opinions or they want to know what else is out there. Sometimes there might be some complexities to deals that we need to solve for, and that's where my team can really provide some value. We've got banks, credit unions, life insurance companies, CMBS lenders. The Fannie Mae and Freddie Mac agency product is highly competitive at the moment. We just quoted a few multifamily loans in the low fives to mid fives, which is quite competitive. Those are also non-recourse loans. CBRE, our company, is the direct underwriter, and we sign credit on those deals. So, if you've got any candidates and you want to talk about agency lending and if it is a good fit for you, we'd be happy to chat about that. And now more than ever, with all the challenges that multifamily owners have to deal with. We pride ourselves on like the value of representation. So we fight for our clients. We want to get you guys the best interest rates, the best terms, and we're more than happy to assess any deals that you guys want to take a look at, or if you want to review your portfolio, we're more than happy to do that as well. Rates generally, just to kind of summarize, the pack of lenders right now, whether it's any of the capital sources that I mentioned, credit unions, banks, life cos, CMBS lenders, everybody's pretty much in this high fives, mid fives to high fives range. Some of the pack is in the 6 to 6.5 range. I do feel like more capital sources are entering into the marketplace. Greater supply of lenders is always good and healthy for the markets. Where rates are heading, I learned not to, speculate because sometimes even the smartest economists get it wrong. But we do, being in the markets every day, we do get a good feel for where things could be heading. It really does seem like, interest rates being higher for longer was the story. Interest rates in the fives is generally a historical average, a normal average. If I had to guess, I think interest rates are probably going to settle off in the mid fives to high fives range for the next, maybe couple of quarters. So that's all I've got. Thank you again for your time, and if anybody wants to chat after, I'll be here. Thank you.
Thank you, Gianni. Just a reminder about your question cards. If a question comes up, go ahead and complete it. Hold it up. I'll have myself or my staff come around and pick it up from you. If not, you're always welcome to ask the questions directly towards the end of the Q&A. And now, for our next speaker, someone every property owner should know. Gino Mattunts is a seasoned insurance professional with over 27 years of experience, specializing in apartment owners' insurance policies. In 2003, he founded SafeCal Insurance Services, a fire and casualty brokerage in Glendale. Gino will be sharing valuable insights on how to protect your investments. So please welcome Gino Mattunts to the stage.
Hi everyone, hope you guys are having a wonderful day. I want to start by thanking Shant and Mary Sherbetdjian for putting this informative and wonderful event together. So Mary already told you a little about myself. I have been an insurance agent for almost 30 years and started and worked at many different positions of the insurance industry. Finally opened my office with my lovely wife, who's sitting in the audience, in 2003. And I pride myself in helping my clients in challenging times for their insurance needs. Thank you. So I specialize in hard-to-place property risks, and it so happens that apartment buildings, all of them became hard to place recently. So I'm able to put in policies for problematic or older units, older properties, and even new ones. Obviously, that's easy. Everybody can do those. But if you have any challenges as far as insurance needs, I'm always available for you guys. If you guys need to give me a call, I can review your properties together over the phone. So a lot of information is online. So I'm available anytime you guys need anything. Of course, and I'll be available at the end of the Q&A session for any one of you guys that have questions. So I get asked a lot of insurance-related questions throughout my daily job. So I wanted to make a presentation for you guys to see what you guys need to do to prepare your properties and yourself, your investments for the challenging renewal process that's probably many of you guys are facing now. So, well, first of all, I just wanted, you guys already know, insurance is very important, protects your building, you get general liability coverage, you get loss of rent, loss of income coverage, equipment breakdown, ordinance of law, some of the aspects that you need to make sure that are in your policy. So it covers, so what's property damage? Property damage itself, it covers the building, it covers the structure, detached garage or any other structures on the property, any fixtures, permanently attached stuff, and equipment. Those are all part of your building or property section. And then you have the general liability, that covers injury, personal, physical illness to a third party, property damage, which includes physical damage to a third party, personal advertising injury, and medical payments. This is all part of your liability. And another thing that I didn't put in here, but it's habitability claims. That's also part of your liability. A lot of you guys have those issues when a tenant complains of maintenance issues or any other bodily harm caused to them. So that's part of the liability, and recently a lot of the insurance companies have started excluding habitability claims. So it's very important that you have a policy, hopefully, that does include habitability. So loss of income is pretty straightforward. You want this important part of the coverage to have loss of income in case of property damage happens and you are not able to lease out your space. So it's very important to have that. Common risks: fire, smoke damage, liability claims, slip and fall, habitability, which we talked about, water damage, disasters, natural, theft and vandalism, and tenant-related damages. These are all should be part of your policy. So what affects the price? Price for each building is different. I cannot stress that enough. You can have similar 10-unit, 20-unit property, and one gets completely different rate from the other one. Very important, location is one. So age of the building, the condition of the building, the maintenance, obviously, the history, if you have had any claims on that particular property, is very important. And then the last part of the rate is the coverage that you choose. You choose to have, you can have basic policy, you can have a policy that covers all the bells and whistles, so that's also the deductible. Deductible is very important as well. That's one of the factors that changes price. So some of the additional coverages and things that you can add on to your regular business owner policy with apartment buildings are flood, earthquake, umbrella, liability, ordinance of law, and work comp. But these are obviously optional stuff. So how do you choose the right policy? Make sure you're approached multiple carriers, assess coverage limits, read the policies carefully. I can't stress that enough where I propose prices and then the client comes back and says, hey, the other guy gave me also $2 million building coverage, but his price is less. Look at, it's the same thing. When I look at the other policy, it has a basic policy, just fire insurance, but I try to make sure the policy is all perils policy if I'm able to do it in that building. So my first choice would be to go with a special policy that covers water, fire, theft, and vandalism instead of just basic. I understand some people have to cut corners, but it's not something where you want to cut corners in coverage. So make sure that's there. Check policy exclusions are very important nowadays because most of these non-admitted carriers have pages of exclusions, and you want to make sure that you read through those before you make a choice. And then for sure, last advice I can give you is to talk to an experienced insurance agent that knows these non-admitted risks and they know what they're offering. So One thing that a lot of my customers are facing nowadays are non-renewals, and I'm sure you guys have all received these letters 60 days, 90 days in advance. State Farm, Farmers left and came back, Nationwide, Safeco, Liberty Mutual, all these carriers, Berkshire Hathaway, Guard, all of them left the state. Some of them came back, and all of you might have gotten a letter called non-renewal, and it's no fun. You have to start looking for a new policy, and the part that when you start looking for a new policy is where you realize what the insurance companies are looking for, because you've been in the same policy for maybe 10, 15 years and had no issues. You know, you paid the bill, something happens, they paid, and no one ever looked at that property that you had purchased 10 years ago, you know. So now what we do is when you call me and give me your address, I look up everything that I can find about that building to present the case to the insurance company. Should they insure this property or not? And sometimes I have clients with very large portfolios. It's properties they haven't seen for years. So, it's something that we have to review together to go through the process and see what the insurance companies are looking for. So that's, next slide is, as you can see, a lot of you guys are facing with this electrical update issue, where the insurance company is asking you if you have Federal Pacific, stop locks, Zinsco, any circuit breakers that are substandard, or fuses, and all these problems that come up from inspection. So there's, in your booklets, there should be a page where it states more of the electrical panels and what the insurance companies are looking for, and if those panels or electrical breakers and sub-panels are present in your property, you will most likely be canceled at the time of the inspection. So they do give you some time to replace or change those panels, but it's better to know before you buy a policy. Then you go through this process of cancellation. And then a lot of the companies have 25+ fees cancellation charges. So you buy a policy that's $10,000 with a $4,000 cancellation fee. So it's not worth going through this without knowing this. So make sure you know what kind of electrical panels you guys have at your buildings. And there's the list of the electrical panels. And then a lot of the clients do, I mean, it's expensive, nobody's blaming you guys, but nobody wants to spend, you know, thousands of dollars updating something that you think works fine. It's been working for 20, 30 years fine, no problems. Why should we update it all of a sudden? But yes, it does require, these updates are required. They do fail. When they do fail, you know, it's not only property damage, people could die in the building, get, smoke damage. So the modern wirings, of course, handle higher increase in power demands. So the breakers prevent overloads. And then my main thing with the electrical updates, it will save you on your insurance. So if you're planning on keeping this property for many years, this will pay off by doing these updates now. So I would say next, besides the most critical of the electrical panels, obviously the roof, plumbing, and then the extinguishers must be always, and they're required, must be always updated yearly. So another issue that I see a lot, and I talk to a lot of my clients, is the inspections that come after the person purchases a policy. So it is something that, I wish I could walk through every property. Sometimes I do. If they're close by, I'd love to come in and go through the property, your own unique property. But a lot of the properties do get an inspection, and then you get inspection recommendation letter within 30 days from the purchase of the policy, and a lot of the inspection problems arise after, and you only get 30 days to fix. So as you can see, this is a property we actually insured, and the concrete and the floors were all uneven, a lot of slip and fall hazard, so the insurance company requires this stuff to be fixed. But if you could just walk through your property yourself, walk and see, if this looks like a problem, most likely it's going to be a problem. So I would definitely pay attention to that. Next is this railings. Some companies are easier to deal with than others, but most of the companies do make sure you have 42-inch height in railings, no more than 4 inches apart of the vertical gap, and they really hate the horizontal ones. So if you have a horizontal railing like in the image, this is a nice building, obviously, but and I love the modern railings, but these are they create a ladder effect where someone can climb up and fall down. If it's a 1-story, maybe not a problem, but when it's 2, 3-story high and then someone falls down, it's a problem. So they do require at least to cover up the ability to climb on these railings. So if you have a property that's like this, I would pay attention and try to get this solved before you get into an insurance issue with it, or a claim issue. Your insurance policy might not give you a problem and insure this property, but why would you want someone to fall? So, and then they blame you. Another thing is roof. So I ask clients, when was your roof updated? Some of them know, some don't know. But main thing is, I say, look up your satellite image of your property. This is what the insurance companies do. They have higher rate, better satellite imaging out there besides Google. But you have Google. Everyone has Google. Look up the property. You can see the red dotted property that I pulled up. Look at that roof and look at the ones next to it. You can tell clearly that that one needs a lot more help than the other ones. So the insurance companies will not insure you if your roof looks like that. So if it does, it could be an older image. So have a proof of repairs or some kind of a letter from a contractor that recently you did the work or cleaned up or whatever it is, that'll help. And if your agent doesn't know, tell them that this is something that you have done. Another thing is a must is Googling your address and going through Street View around the property. This is what every underwriter does. Every time they're looking at an application, this is what they do. They go, they look it up, and they go through Street View. This is an alley, actually, of an apartment building that we insure. And you could tell it's probably neglected for a while. There's a mechanic shop almost in the back, and trash and tagging and things like that. So all of this is stuff that the insurance companies looks at, and there's a hazard in their eye, even though this could be just a guy fixing his car that day that they passed through. The insurance company is going to ask you questions, and they are going to want photos of this car not being there, stalled, parked, whatever it is. So these are stuff that I'm telling you because some of these problems your agents might not be familiar with, so it is something that you want to be very proactive on. So another main thing is, obviously within the past 3 years, insurance industry constantly changing. But these fires, the recent fires with 16,000 homes burned, and there are almost 29 people dead, 45 billion in damages. What will a lot of my clients ask, and I'm sure you guys think, what's going to happen with the insurance industry after this? So obviously, when this happened, none of us expected, something like this traumatic. But the insurance company has bounced back, most of them. Most of them are back to normal process. Some companies, after leaving, didn't come back, but they're reassessing their values, trying to figure out what they should charge coming back. This is completely, new norm. But definitely, it's going to present more challenges. They're using a lot of saturation software now, where the insurance company doesn't want to insure too many properties in one location or on one street. So that's a major thing where, if they already have a building on that block, they might not insure another one. So they have all this new technology that they're implementing. So it is going to be a lot more challenging going forward, and the insurance companies are most likely going to increase more rates in brush areas, or even get stricter on what locations or how close their brush threshold is. And now it's maybe a mile, they might even go to 2 miles away from brush. And that's most of San Bernardino Valley, or all this, Pasadena, Glendale, all around the 210. This could be all zoned as brush. So I don't know about the cost of the electrical panels. A lot of you guys are probably facing with that, but there is a good news. There are a couple of insurance companies that started writing some of these older panels. They're a little more expensive, but there is a couple of companies now that they're writing the panels and they're letting the panels stay. Now, is 3 times more expensive than their regular policy? It might be a temporary fix for some of you guys to go into something like that until you guys get the panels and all the electricals updated. But there's other choices out there. So that's pretty much it. If you guys have any questions after, for sure I will be available at the Q&A, and my number is on the brochures as well. You guys are more than welcome to give me a call with any questions. Thank you.
Right, I'm not as tall as him, but thank you, Gino. Our next speaker is Kirk Felikian. Managing apartment buildings efficiently requires expertise, innovation, and the right technology. Kirk brings over 25 years of experience as the CEO and founder of Next Level Management. As an apartment owner himself, Kirk understands firsthand the challenges landlords face. Let's welcome Kirk to the stage.
Hello and welcome, everyone. Thanks for taking the time to join us today. And I want to thank Shant and Mary and the group for putting this together. It's greatly appreciated, and I know it's very informative. So before we get started, again, my name is Kirk Felikian with Next Level. I wanted to give you a little bit of history about me. I started in the real estate market around 2000, working for family. And in 2007, I decided to get licensed and to take advantage of the 2008 boom, as they say. So with that being said, we're going to talk about the pros and cons of property management, because I'm sure some people are contemplating property management, and I know that property management today doesn't have a really good rapport or a good reputation, but I'm here to tell you that it's changing. I got started, I'll give you a little background. Like I said, I got started in 2000, got licensed in 2007. I worked for RE/MAX, along with my mentor, learning the ins and outs of commercial real estate sales, focusing mainly on multifamily properties. For the next 5 years, I focused on sales. I made what I call the perfect mistake. I showed a client of mine properties I was managing for family, and after seeing that, he liked what he saw, and he wanted me to start managing his properties. I declined that. I told him I'm a sales guy, not really a management guy, and he pursued and tortured me for the next year until I finally gave in. I left the management business, sales business shortly after that, and started full-time management. I realized how many owners were unhappy with the property management companies that were out there today. So what I did was I decided, let me take a different approach to property management. Let me do more of a owner-to-owner, since I owned my own buildings, an owner-to-owner type of relationship, instead of an owner-manager relationship. I shifted that, I used that mindset, and it kind of worked out great. It's been working out great. I treat the owners the way I want to be treated, and we're responsive and, answer as many questions as we can. That's something that I learned managing family properties, if anybody knows, if anybody manages family properties, and when you have to have that monthly meeting, families are the hardest ones to deal with. So that was one thing that I learned, and I brought that into the management business. Now, moving on, I wanted to kind of go over some pros and cons of property management, and these are the highlights that I got from pros and cons from the owners and my clients that were hesitant about hiring a management company. The first thing is loss of control. Many owners that handle their own not their own day-to-day operations. They're sometimes are stressed out because they don't feel like they can let go of control, or some of them have an unease about outsourcing management to a complete stranger, because basically we are strangers. The second one is an increase in expenses. Unfortunately, the management services is going to cost us, is going to add to your bottom line. The third, challenges with little or no communication. A lot of management companies will either treat you like a number, or they'll delay getting back to you, or sometimes they don't even get back to you at all. They'll just shoot you an email, which that's what I've encountered with a lot of owners. That was another big thing. But despite all those challenges, there's several other pros with property management. First, it frees up your time from day-to-day operations, because management takes care of the rent collection, tenant issues, 24/7 maintenance issues, vacant property rehab and showings, and which frees up the owner to have his own time and deal with family and other responsibilities. The second is legal compliance. Management stays up to date with the latest the laws at the county level, the city level, and the state level as well, ensuring compliance that reduces your legal risk. Third, preventative maintenance. Regular property visits from management helps identify potential issues. And as everybody knows, and as you just heard from Gianni, there is a lot of insurance companies that do these inspections. A lot of banks are doing them now, and cities are doing them now as well. So we mitigate that by doing the inspections, because we're familiar with what they want now. And so we try to do preventative maintenance. We'll go inspect the property, discuss with you, hey, these are potential problems, and we need to get those taken care of before the bank brings it up, insurance brings it up, or even the city. Number 4, quick vacancy turnaround. Management will rehab and fill vacancies quickly with qualified tenants, because a long vacancy period means a loss of income for the owner. And I know how that is, because I'm an owner myself. So the quicker we do it, the better it is. And the last one, you receive detailed financial reports. Owners receive detailed monthly financial reports with income and expense breakdowns, making it easy to analyze a property's performance. Now, those are the pros and cons of management. I know, like I said, people are contemplating, but there's a huge trust issue. And again, when I started, like I said, when I started back in 2000 with the family business, we had a management company, and I encountered some of these items that I brought up. And but I know the management industry's changing, and there's we've got a better approach to it. Like I said, I have this approach, and it seems to be working out great. And I'll be looking forward to the Q&A session, and thank you for coming again.
All right, thank you, Kirk. Now, our next speaker graciously stepped in for Louis Goros. Unfortunately, Louis couldn't join us this afternoon, but we're excited to have him today. Stephen Adams, first vice president at Kingsbarn, brings extensive brokerage experience and deep market insight, helping clients navigate investment opportunities through Kingsbarn's active DST offerings. Please help me welcome Stephen to the stage.
Good afternoon, everyone. Shant, Mary, thank you for having me. It's been a great event, and I hope it's as informative for you as it was for me. My name is Stephen Adams. I'm from Kingsbarn Real Estate Capital. We're a DST sponsor based out of Las Vegas, and my office is just about an hour away from here in Newport Beach, California. Before I get into the presentation here, the DST advantage, I just want to go over some of the issues that I'm hearing on the phone, speaking with landlords like yourselves every day. What I call the 5 T's: tenants, toilets, trash, taxes, and turnover. And of course, the theme of what we're hearing today from our past speakers is legislation throughout the city of Los Angeles. Has been an issue that's causing a lot of investors to determine what their next move is going to be. The DST is a solution. If any of those problems resonate with you and struck a nerve, the DST could be a solution for your next 1031 exchange. So this is just an overview of what we're going to cover today. I'm going to move relatively quickly through the slides, but again, I'll be available for the Q&A. And I could give out a business card if you want access to the full PowerPoint presentation. I'm happy to send it to you, available for a call or meeting, whatever's best for your schedule. So information about Kingsbarn. So Kingsbarn's been around for 35 years. We've been doing syndication. The DST really came about in 2012 when there was a major transition from the tenants in common, the TIC structure, into the DST. Since then, we've grown the company to just over $2.2 billion worth of assets under management. Our average return to our investors is just under 6%, and that's a cash-on-cash return net to the investors. We're in 28 states throughout the country, so a lot of you that are possibly looking to get out of California, we're able to help you there, but we do own property in California as well. So what we offer, Kingsbarn gives you access to institutional grade real estate. So everything with Kingsbarn, our deals are typically $30 to $100 million. You're going to get corporate-backed guaranteed leases. You're going to be in Class A locations, and a lot of our buildings are going to be brand new construction as well. All the financing, all the due diligence is already done for you in this process. So what we do is Kingsbarn's a one-stop shop. We do everything from start to finish. So what we'll go out and do is we have an acquisitions team in Las Vegas that will go out and identify the real estate. We'll close on it with our own funds. We do have all cash DSTs for people that own their properties free and clear, but we also have leverage DSTs as well for people that need to replace debt in their 1031 exchange. It's typically leveraged at 50% loan to value, non-recourse debt, and Kingsbarn's the guarantor of the senior note. And then once we close on that property, we backfill it with investors like yourselves, and you guys get monthly cash flow, all the benefits of real estate ownership, so you'll get the depreciation, appreciation on the sale as well. So understanding 1031 exchanges, Greg Burns is here, who's an expert in 1031 exchanges, so I'm just going to give a general overview. Basically, every one of our DSTs has a tax opinion per the IRS code, and we've never had a single lawsuit with any investor moving from an apartment deal into a DST because it's considered a like-kind asset. So higher value properties. So what, again, as I mentioned earlier, it gives you access to institutional grade real estate. So here you're getting, again, a corporate-backed guaranteed lease. I have had issues with clients where, they're looking at a triple net, they don't want management, but they want to tackle the building by themselves. Typical real estate ownership in LA, $2 to $5 million. I had a client that went into a Dollar General, 10 years left on term. They ended up running that lease all the way down to the end. And what did Dollar General do is they didn't re-sign the lease. They moved across the street and built a new one. And this owner was left with pretty much just the land value of the property until they re-tenanted it. So with us, you get a little bit more of a safety and security in your investment. And that's just one of the many benefits of going with Kingsbarn. So this is just general timelines for your 1031 exchange. It's 45 days to identify your property, and then from there, 180 days to close on that property. The role of the qualified intermediary, this is your accommodator, your facilitator. In order to do a tax-deferred 1031 exchange, your money has to move from the sale, the escrow, to the qualified intermediary. Then you're going to enter your 45-day identification period, and then within that 180 days, you're going to close on your upleg property. And this is an example of utilizing the 1031 exchange versus just cashing out and paying capital gains tax. We know California loves their taxes, and I do have clients that ask me, why should I not just cash out and put it in a treasury bond to get 4.25% return? It's as safe could get. If you look at the numbers, if you do a 1031 exchange, you have your full $1 million worth of equity that you're able to exchange with and earn with Kingsbarn 6% on that, versus if you cashed out, paid capital gains tax, you now split your investment in half and are most likely getting a lower return on it, and you're not getting the benefits of real estate, the depreciation and the appreciation as well. So about DSTs, a DST is just a legal trust. So Kingsbarn's the trustee, and you're an owner in that trust, but you are getting fractional ownership in individual real estate. So you are still an owner in real estate. This is not a REIT. It's not transferred into operating shares. You have physical ownership in a tangible asset. So it's just a simplified 1031 solution. So this is our document vault, which we give all of our investors access to. They have access to all of the due diligence items that we used when we closed on the property, the phase one, the zoning reports, the insurance, the lease agreements. Everything's available for you to dig in at your leisure, send to your attorneys, have it for review, but it takes some of the stress out of doing that yourself. So the benefits to you guys. So basically, again, you're getting access to a safer and secure tenant. A lot of our tenants are FedEx, Ryerson, Tesla, some larger corporate-backed guaranteed companies. You're deferring your capital gains. You're meeting your 1031 exchange timelines, and you're getting truly passive income. These deals are 100% management free. It's all handled by Kingsbarn and done in-house for you. So using a Delaware statutory trust in your 1031 exchange, as I mentioned, these all have a tax opinion, and you're able to do a 1031 exchange because it's like-kind property, but you do have to be an accredited investor because it is considered a security. So an accredited investor, typically owners in California, don't have any issues with that, and they cover under the $1 million net worth because you're able to use the sale of your down leg as proof of income. So if your property sold for $1.5 million, you use that closing statement and you're automatically an accredited investor. You could also have $200,000 worth of income if you're single and $300,000 if you are married. A lot of my clients ask me about estate planning, and if the DST, if they sold their property in a trust, are they able to invest into a DST in their same trust? Are their heirs going to be protected if they pass away? And is there a stepped up in basis? It's the exact same as fee simple real estate, and typically whatever the relinquished property's vesting was held in, that's what the DST will be held in as well. Of course, you could change it later if affairs do come up, but we are able to hold it in a trust, LLC, husband and wife, sole owner. The DST exit strategy. So our DSTs are typically held 3 to 5 years for single tenant deals, 5 to 7 years for multi-tenant deals. And what we'll do is 6 months to a year before we sell that asset, we'll give all our investors a notice that we're doing a disposition so they could get their affairs in order. And from there, once we sell the property, you have the freedom and flexibility to stay with Kingsbarn. Of course, we would love to keep your business. About 90% of our investors do. Unfortunately, some do pass on and their kids take the stepped up in basis. But you have the flexibility to potentially, if rates come down, move into another fee simple property, 1031 exchange into an apartment, a retail deal, or you could cash out and pay capital gains tax. So you're not married to Kingsbarn or the DST. Here's just a couple success stories about individuals that had management-intensive real estate. They no longer wanted to deal with the headaches, the tenants, the toilets, the trash, the things we mentioned. We diversified them into multiple DSTs and increased their after-tax income by 15% for an individual, 20% for an individual, and there's plenty of stories and references that you could speak to that have invested with our company and are happy with the outcome, and most importantly, the stress of not having their phone ringing all day because of a leaky toilet or a tenant that's having an issue. So 8 days, this is just a case study. We could close the DST in as quickly as 24 hours. This is a huge benefit for investors. It is used as a backup strategy for some clients that are looking at a fee simple deal, but there's issues right now. There's issues with lending. So they want a guarantee that they're going to be able to close on something and not pay capital gains tax. This is a great way to ensure that this is going to be available and able to close for you. But what we like to do is when you're in the escrow stages and you have an offer, that's when we'll really sit down with you and build a portfolio allocation. So once you close on your downleg property, the money goes directly to the accommodator, and within 24 to 48 hours, you could be in the DST accruing interest from that day. So as I mentioned, that 45-day identification period, 180 days to close, you're looking at close to 6 months of not receiving any cash flow because your money's sitting with the accommodator. So the DST really gives you quick access to getting cash flow on a reliable institutional grade piece of real estate. And these are just quickly, I'll go through our current offerings. So we have a student housing portfolio just outside of University of Mississippi, 176 units, never had a single vacancy since it was developed. This was not like the dorms I was in at Rutgers or when I was in the Marine Corps. So these are Irvine-style apartments, very Class A. All the leases are backed by the parents. And this one's paying a 5.25% return right now. We do have another student housing portfolio, just a different location on University of Mississippi, paying 5%. We did close on a portfolio of Tesla sales and service centers, regardless how you feel about Elon Musk. I know some people love him, some people hate him, but they're the 8th largest company in the world per market capitalization, and they signed a corporate-backed guarantee 15-year lease with us. So these are at 5 3/4, and we have another one at 5.5%. KB Shepherd, I could go on for a long time about these deals. They're great deals with Travel Centers of America. The tenant is Las Vegas Petroleum. Travel Centers of America was bought out by British Petroleum last year for $1.4 billion, and they're the #1 franchisee. These we see extreme growth in. They're at a 7% return. Brand new 20-year leases in place with these properties as well. We also have an acquisitions and development fund. This pays 13.75%. It's a $250,000 minimum, and what it is it's 1099 income. You're not able to 1031 exchange into it, but pretty much every employee, including myself, is invested with it at Kingsbarn. It's never missed a single distribution, and what it's used is to go out and for us to do ground-up development on some of these projects that we're working on, and I'm happy to provide further information on that. And then this is just a program recap of what we covered. Again, I'm available. I'll have business cards available for everyone here if you want to reach out, just have questions. But it's just another solution for you when you're looking for a 1031 exchange, you're tired of management-intensive assets, and looking for something more passive so you can enjoy, vacations, grandkids, and spending time with family. So I appreciate it, and thank you.
Thank you, Stephen. So, our next speaker. Estate planning can be daunting, but our next speaker has made it his mission to help property owners and investors navigate these crucial areas with confidence.
Ali Talai is founder of Talai Law Offices, a boutique firm specializing in estate and tax planning, probate, and business planning. With a client-first approach, he provides sophisticated strategies for real estate investors and high-end net worth families, helping them protect and grow their wealth. Please join me in inviting Ali Talai to the stage.
Thank you guys. This is how I get my exercise. I don't exercise much. But thanks, I want to thank Mary and Shant for having me. Thank you so much. It's great to be here. I get to chat with wonderful people like yourself. I'm a trust and estate planning attorney. This is a second career for me. I used to be in real estate, and then 2008 happened, and decided to figure out I need to do something else. And this is the backup plan. So hopefully this works. If not, I'm going to become an apartment owner. I think that might be a better choice down the road. To tell you a little bit about myself, I'm a trust and estate planning attorney. That is all I do. We try to stay focused. One unique thing about me, besides having some real estate background, is that I'm also a tax attorney. I figured going through law school wasn't enough, so I kind of did law school, then went back to law school, got an advanced tax degree. And what it really allows me to do is to, I think at least, that I could do better estate planning, especially for individuals that have higher net worth. And we're trying to do estate tax planning, we're trying to do asset protection planning. And then in California, you have all these rules about transferring properties into an entity or a trust. And how do we do that without reassessment of property taxes? There are a lot of taxes in my world that I get to deal with. And so that's sort of our niche. Our office is in Woodland Hills. We help clients all over California. I do a radio show on Fridays at 9:30 in the morning on 670 AM. It is in Farsi, so if you speak Farsi, please tune in. If not, I will do my best to speak English while I'm here. But I get to talk about relatively the same stuff. I talk about estate planning a lot and some of the ins and outs of estate planning. And my slides today, I get to do it. Oh, I was waiting for somebody to turn the slides. It's me. I am married. I got a couple of kids. They always wonder what daddy does at work. I do take him to the office every once in a while. All right, so I'm going to kind of tell you what I'm trying to cover in this 15 minutes that is allowed to me. I'm going to try to talk to you about holding your titles. What's the best way to hold titles to your apartment buildings and real estate investments? Is your liability protection solid? And we're talking about insurance. That's obviously a part of liability protection, but also as far as estate planning, maybe LLC planning, irrevocable trust, and the different kind of trusts that are out there. And then we want to talk about how will your beneficiaries actually receive your estate when you're not here. All right, so let's talk about holding titles in your name. In estate planning, there's a couple things. One is that, at one point we're all going to not be here, not the most exciting thing. But so when we talk about estate planning, we want to make sure we have an estate plan in place that if we're not here, we could do it in such a way, our asset could transfer to our kids in such a way that would be the most efficient way, a way that would cost them the least amount of money. I do a lot of probate cases as well, not by choice. It seems to be if you're going to do estate planning, you got to go to probate court every once in a while. And it's definitely not a fun thing. It's very expensive. It takes a very long time. Our average cases are about 1.5 years. If you don't like your kids, I think you could skip doing estate planning, just give them one last, goodbye, I think. But I think most of us here do like our kids, so I would suggest making sure you have the right estate plan in place. And the reality of it is, part of the estate plan is to figure out how do I go about trying to put an estate plan in place that when I am not here, my kids don't have to go to probate and all the stuff that this guy told us about in this Lunch and Learn. The other question becomes, if you have a larger estate, how do we put an estate plan together so that we could disinherit the IRS? Nobody really likes the IRS. Why are we going to give them 40% of our estate, 45% next year? So then, as part of the estate plan, how do we eliminate estate taxes? And then the other portion of it is, how do we put a plan together that if this tenant that I got in here for some reason decides to file a lawsuit against me, that I can shield my asset? And that becomes a big part of doing estate planning. Obviously, there are different ways. We never want you to hold property under your personal name, again, because of probate. The other thing is, if you own property under your personal name, and if there is a lawsuit ever filed, that's how the creditor wants to see it. They want to search. I get to be an expert for a lot of attorneys that file lawsuits. They hire me to go through the trust documents and LLC documents and the client's portfolio, so I could tell them how they could sort of break into some of these things. And so one of the first things I suggest, and a lot of the things that I do for a lot of the clients that work with me, is that I don't want you to own any property under your personal name. That's number one. Part of asset protection planning becomes privacy. Not that we're counting on privacy. Privacy planning, having a land trust in place, or some of these trusts that hide or makes it more difficult for somebody to find out what I own, is not the asset protection planning. But we don't have to tell everybody what we own. So that's what I mean. But we don't want your name to be on your assets. We want them to be held in a trust. We want them to be held in an LLC. We want them to be held in a holding LLC. We use a lot of Wyoming holding LLCs. We use a lot of Arizona limited partnership. Sometimes we do Nevada LLC. Lots of different strategies, lots of different things that we could do. We do a lot of irrevocable trust. So there are definitely better options to hold them. As far as is your liability protection solid, insurance is definitely a big factor. I do a lot of asset protection planning, and a lot of times when I do these sort of planning, I tell people that our asset protection planning is to be a layered asset protection. Insurance is always the first layer. With asset protection, there is really nothing in place that you can do that would 100% protect your apartments, your ownership in real estate and other assets that you have. If somebody tells you I have a bulletproof asset protection planning in place, there's probably three things. One is they're not being very honest with you. Number two is that they just don't know what they're talking about. And number three is 1 and 2. Because it really doesn't exist. With asset protection, what we're trying to do is to make it more difficult for a creditor to come after our assets. The more difficult it becomes, it allows us, what happens is that, one is that they may not even go after our assets. If we have a really good insurance in place, umbrella policy in place, great general liability policy in place, and now we got a good structure in place as well for asset protection, a lot of times what happens is we're pushing him down towards the insurance and having him settle for the insurance policy. We want to have layers, so now if something happened the insurance company didn't cover, as you know, these insurance companies, they make their money when they don't pay up. That's one of the ways they make a big chunk of their money, when they decline a claim, when they come up with some sort of detail saying, oh, you did this thing here, you added a ADU to your property, you rented it, and you didn't make any change to your policy. That's not covered. Or you place your apartment into an LLC and you didn't update your insurance. Oh, we don't cover you anymore. So the idea with layered asset protection is that we want to have multiple layers. So if something happened, the insurance for whatever reason didn't cover, we got something else that we could safeguard our assets. If something happens, our LLC planning for some reason didn't work, we have the insurance to sort of safeguard the assets. So as part of the work that I do, we want to create a structure that could help, depending, again, your need and what the main goal is. Obviously, a big portion of estate planning is to have something in place to avoid probate, do better planning. We could do a really, really good asset protection for our kids. When we're not here, when we're gone, and now inheritance are going to our kids, most people I talk to, they don't want their kids' inheritance to be taken away or having their child lose half of their inheritance because they got a divorce. Or they most likely don't want somebody come in and take their apartment building because their son who inherited the apartment building got in a car accident. So we could do really great asset protection planning for the kids. We could do great asset protection planning for you while you're alive. Obviously, we could do great estate planning to avoid probate. And then estate tax planning becomes a really big issue as well. I am not exactly following my slides here, so I've gotten too excited to kind of share some of this stuff with you already. We want to have a plan in place that allows the transfer of asset to be in much easier way. And again, it kind of goes back to stuff that I was telling you about, having the right trust in place, avoiding probate, having structures in place that allows you to avoid capital gains taxes, avoid paying death taxes at the time, unfortunately, a person passes away. Those are all part of the asset protection, part of the estate planning that we want to have in place. I think with that said, I'm going to sort of wrap up. The key takeaways: you don't want to own anything under your personal name. We want to have it inside of a trust, LLC, some sort of entity. You want to make sure you have the right asset protection in place. And lastly, we want to provide something that when we're gone, our asset could transfer easier. If we could avoid probate, and for example, for $1 million property in California, the minimum statutory fee is $46,000. So if we could avoid probate, it just means our kids are going to inherit more as well, less going to the state. Thank you so much. I appreciate it.
Fantastic. And for our last speaker of the day, real estate law can be complicated, but our next speaker is here to simplify it for you. Nadav Zohar is a partner at Kimball, Tyree, and St. John LLP, where he leads the property ownership group in Los Angeles, specializing in landlord-tenant matters and real estate litigation. Nadav has been recognized as Southern California's Super Lawyers Rising Star from 2019 to 2024. Please welcome Nadav.
Good afternoon, everybody, and thank you for being here. Thank you for Shant and Mary for hosting this beautiful event. I speak in front of apartment owners through associations all the time, and I'm not just saying this. This is the nicest event that I've been through. The food was great. Also, the pamphlet has a lot of great information. The cheat sheet, I encourage everybody to take it with you and to spend some time to reviewing it. So I'm with the law offices of Kimball, Tyree, and St. John. Our bread and butter is evictions. Anybody here ever filed an eviction? Does anyone like filing evictions? What about paying for them? Cost went up, right? Maybe 10 years ago or 15 years ago, you can do an eviction within 30 to 60 days and pay less than $1,000. Today, we ask for a $2,500 or $5,000 retainer. We have hundreds of cases that legal fees can go upwards of $50,000. Why? Because evictions are extortion platforms against landlords. And we are here to support you, to back you, to aggressively litigate for you, just for your simple right of collecting rent. And it's a very sad state of the law here in LA or in California in general. I'm not here to sell our services. As a matter of fact, my goal is, I hope that no one here will ever need me or another landlord-tenant attorney, because it's not good when you need me. We have here insurance brokers and real estate brokers and 1031 exchange. When you contact them, it's for a good thing. You're happy. You're closing a deal. You're making money. You're saving for your family. But when you contact us, it's usually for a negative thing. You're being extorted by a tenant. You're being sued by abusive tenant attorneys. And it's gradually becoming worse and worse. Today, what I'm going to speak about is, as you know, Mary mentioned that landlords are a moving target. There's always changes in the law. There are many changes in the law, but I only have 15 minutes. So I picked 3 or 4 changes in the law that are taking effect right now. Some took effect in January, some took effect in March, some will take effect in April, and some will take effect in July. And these are not just laws that you're not going to notice. It's going to impact every one of you if you are a property owner that has rentals. It's going to impact your day-to-day operation from day one. Kimball Tyree St. John has been in business for 45 years. We represent landlords exclusively. We get calls from tenants all the time. We don't represent tenants, only landlords. Okay, so let's jump to it. The first law that I want to introduce is a brand new law that passed just less than a week ago. It relates to the fires that happened. LA County decided that they don't trust landlords. They think that landlords are devils, are demons, that all they look for is to evict tenants. So what did they do? They are interfering with your contract, and they're telling tenants that now they don't need to pay rent from starting February 2025 through July 2025. A tenant can self-certify anywhere in the county that they cannot pay rent because of the fires. And if they do that, you cannot enforce failure to pay rent, and you cannot enforce the contract that was signed that the tenant promised to pay rent in exchange for housing services, right? Now, that doesn't mean that you don't need to provide housing services. You must provide housing services. If a tenant doesn't pay and you give him problems, maybe you're going to want to defer maintenance. You're just creating more liability to yourself, and you're going to end up calling me or a landlord attorney to help you. You're going to need to spend more money. The slide has a lot of specific details, but we don't have time to go through the details, so I'll give you the bullet points. The rent from February 2025 through July 2025 for those that self-certify under penalty of perjury that they cannot pay rent, it's all deferred by 1 year to July 2026. Guess what? In July 2026, if they don't pay it, you can't evict for that money. What can you do about it? Probably nothing. You'll either need to spend money on suing them or sending them to collections and lose 50% of the value right there and then. One last bullet point on this is that the tenants need to self-certify in writing under penalty of perjury within 7 days of the rent being due. So for March, by March 7th, they should have or should notify you. I would be interested in knowing if anyone in this room would get these types of notifications, and I'm happy to give my information after this. I have business cards, and whoever gets this notification, I'm offering you free legal advice to call me to see if the notification is valid, to make sure that your tenants are not abusing the law. The next item that I would like to discuss is application screening fees. So does anyone here have new tenants or thinks that they will have new tenants in the next month or so? Yes? Okay. And do you charge screening fees or application fees? No. Okay. Smart man. Because now the regulation is so rigid that sometimes it's not even worth charging these application fees. But now AB 2493 that was recently passed and went into law dictates what you need to do with application screening fees. First of all, you must not charge more than your actual cost. So if the company that you're using charges you $40, you need to charge $40. If you charge more than $40, let's say for overhead or whatnot, you need to be able to articulate how you got to that specific number, and it's probably not worth it. They also dictate that now you can't just take a batch of applicants, run them all through your system, and choose which one you like most. You only have two options. Option number one, just put the right screen. Option number one on the left side of the screen means that you're processing applications in the order in which they were received. So let's say you have, right now with the fires, a lot of people are being relocated or forced to relocate. You have 10 applicants. You can't take them all. You need to take the first one who applied, and if they qualify based on your rental criteria, you need to accept them. If they don't qualify, you need to reimburse their application fee and move on to the second applicant. The second option is for you to take a batch, run them all through, but whoever doesn't get approved gets back their money. So it's up to you how you want to handle it. I think that from a fair housing standpoint, to reduce liability as much as possible, do it one by one and stop when you have a qualified applicant, so that it's less likely that tenants that you kind of process through a batch will say, oh, you discriminated, or oh, you don't like my gender or my religion, or any other excuse that we see all the time. One more thing is that you need to consider two sets of laws when it comes to application screening fees and application paperwork. Number one is state law that states that once you run someone's credit, within 7 days you must provide them with a copy of the credit report. And if you don't do that, you're in violation of the law, civil penalties and lawsuits. The second layer of the law is federal law. Federal law says that if a tenant requests a copy of the credit report, you must give it within 3 days. So what would be the best practice? Just give it to them within 3 days if you are in fact running their credit report. Okay, the next big item, in my opinion, is security deposits. Anyone here holding security deposits? Okay. Anyone plans on collecting security deposits in the future? This side, no? Oh, okay. So as you know, the last maybe 6 months ago, a new law went into effect. Starting July 1st, landlords can only demand how many months? 1 month, right? You used to be able to do 2, used to be able to do even more than that. Now it's only 1, and that includes pet fees and furnished apartments and all that. Only 1. Now this new law states that when you give a security deposit itemization, there are 2 main differences that you need to be aware of. And I recommend that you either follow up with me for this, for a copy of this presentation, or make sure that you're knowledgeable about this, because this is one of the biggest kind of animosity between landlord and tenant issues that I see. Number one is that starting April 1st, which is less than a month away, you must provide the tenant or the tenants with photos of the unit as the unit looked like when they vacated the premises. In addition, you must provide in the security deposit statement an explanation of exactly what you did for the charge that you've charged the tenant on their security deposit. So for example, before April 1st, a tenant smeared feces on the wall, and it's not an extreme example, this happens all the time, because I'm dealing with evictions. These are bad tenants that end up hating the landlord, hating the landlord's attorney. You now need to take photos of the feces on the wall. You need to take photos of the wall and to show what it looks like after you painted it. You need to provide the tenant with photos from the before and after, and you need to provide an explanation, almost like a paragraph, on the statement saying, removal of feces from the wall, triple painting it with so-and-so paint. Be as detailed as you can because you're a moving target and people like suing landlords. The law also allows you to communicate the photos by mail, email, or any other electronic device that you see fit. You can take videos, but I also recommend always taking photos. One more thing about the security deposit statement was that in order to be able to deduct now, if you have a new move-in, does anyone have a potential new move-in soon? Right? You must take photos of the unit and all the inside of it prior to the tenant moving in and store it in your file. And then when the tenant moves out, I don't know, 15 years later, 10 years later, make sure that you can find those photos and that you're going to need to provide them with the security deposit statement when they vacate. One more issue that comes up with these types of requirements is that, sure, an individual owner that owns a few duplexes, they're very hands-on. They do everything alone on their own. They'll take the photo. They'll do the security deposit statement. They'll mail it. But if you have agents, does anybody here have on-site agents? One person. If you have agents that work for you, they may change jobs 2 or 3 years into their employment. If they took the photos, maybe, and this becomes an issue in litigation, now you need to depend on somebody that you may have fired, that you don't even know where they are, to testify that those photos were taken by them at a certain time. So I recommend having these tasks be done by people that will be with you long-term, either the owner or the family or agents that you at least predict them to be there long-term. Okay, one more law. This one is a quick one. SB 611. Sometimes you have a tenant who routinely is late with rent. You serve them a 3-day notice to pay rent or quit, and maybe you hired an attorney to do that for you. Maybe you hired a process server to serve the notice. Any notice that you serve or any paperwork that you serve and that you incurred a charge, even if your lease agreement states that you can deduct from the security deposit those charges, SB 611 now says, no. You cannot deduct any pre-litigation work from the security deposit moving forward, even if your lease agreement states that you can do that. Do we have more time? Where's Mary? Yes? Okay. We do? Okay. This is also a big one. It's very detailed. And it's going to be it's not going to be easy for me to articulate this law in the most accurate and narrow manner in 15 or so seconds. But what is the bottom line? AB 2747 now creates a rights for tenants that are paying, that want to and are paying rent on time, that their good payment history be reported to credit bureaus. So if a tenant pays on time for 10 years, they can have good credit now because the landlord is obligated not only to report it upon request, but to also offer it at the inception of the tenancy in writing and to document their acceptance of that offer and their rejection of that offer and to put it in the file. This is a very important law in my opinion, but it's limited to who it applies to. It only applies to buildings or properties that have more than 15 units. Does anyone have here more than 15 units in one building? Okay, we have a few. You're going to need to make sure that starting April 1st, 2025, you do what needs to be done with new tenants and existing tenants. And you can follow up with me later. We have a package that is pretty affordable that basically gives you everything that you need ready to go to either include in your lease agreements or to proactively offer to your existing tenants. And because this is very detailed, I'm not going to go into all the details now. Let's see what else we have. Something minor. There's more domestic violence, unfortunately, and victims of domestic violence are entitled to many, many protections. I'm not going to go through all of them, but some of those protections are that they have the right upon demand to ask the landlord to change the locks or to change the locks on their own. And you cannot charge them for that. You cannot add it to their security deposit statement. It's just another layer of protection that I don't think was necessary. Balcony inspections, you all know, was now extended to January 1st, 2026. And last but not least, unlawful detainers, our favorite subject. The legislator found that even though it's considered a speedy proceeding where they envisioned evictions to be able to be concluded within 30 days, and even though now it takes more than 6 months and more than $20,000 when a case goes to trial, they decided to come up with a new law, AB 2347, that extends the defendant's response time for an unlawful detainer from 5 days to 10 days. They also added another type of responsive pleading to the unlawful detainer. It's a motion to strike, and that's another delay tactic that tenants and abusive attorneys are using moving forward. And with that said, I have my business cards. I'm happy to answer questions. And hopefully, like I said, you guys are updated with the laws. There are many more laws to know about. Thank you very much for your attention and your participation.
Thank you, Nadav. So we are going to start our active Q&A session. These are such wonderful questions that came through. I'm going to try to get through them as fast as I can, fire them off to our guest panels, who I would like for them to join us right now up on stage. Now, if I don't get through the questions, which I feel like I will, but if I don't, by any means, please, all of our contact information is on back of that folder or the welcome booklet that you received. Please reach out to us directly, our office, even Shant directly. He is on his emails all the time. Say, Shant, I'd like to, clarify this one question I had for the panelists, and we'd be happy to connect you both. Sometimes their offices tend to get busy. Those lines are busy, and if you can't get through, please call us directly as well. So while they make their way up here, I've got one guest that's up here that wasn't part of our speakers, but he is an expert. This is Greg Burns. Greg, raise your hand, please. Fantastic. Greg is an expert in the 1031 exchange rules and regulations of delayed simultaneous reverse and improvement exchanges, and provides nationwide services to his clients through National IPX 1031 network. He knows all about how the rules and regulations of exchanges work. So if any exchange questions, by any means, we've got a hot mic also available during the Q&A. So I'm going to start with a real quick, fast fire round questions. These answers will be short and sweet, but again, if you'd like to elaborate a little bit more on that, they can hang out a little bit after the seminar, and of course, you're welcome to reach out to us and them directly. First question, if no forwarding address is given, does sending photos to the vacant address work? AB 2801.
Last known address. If the tenant didn't provide a forwarding address, the last known address is the address of the subject premises that the tenant vacated.
Thank you, Nadav. Those mics are available to you also, panelists, so if you can grab one of those and turn it on, they're ready to go. AB 2493, if we use an applicant platform like Zillow or Rent Space, a platform that takes an application fee but may allow the tenant to submit the results to multiple landlords, what is the landlord's responsibility to return application fees there?
If the landlord collected the application fee and the tenant was denied, the landlord needs to return the application fee. And there are many moving variables with this question. I'm happy to discuss it after this Q&A session.
What is the average deductible amount to use with rising insurance costs?
Well, that kind of depends on the size of the property, coverage. I would start at 5,000 for at least 5 and up units, and I don't think it's really making that much difference after 10,000. It's not enough. But yeah, we can give you many different options to figure out which one you want.
Do all insurance companies have corrective items to continue insurance, meaning in renewal, are they all subject to inspections and they have to correct these items in order to continue?
So the inspections do come in when you newly purchased a property. They might not do the renewal. They might ask for you to do self-inspection at renewal or send them a photo or a concern of a roof or something else, but they tend to not do inspections at renewal.
I built an ADU on a primary property with a separate address, and now my insurance will not cover the ADU since it will be rental and it has a separate address. How can I get coverage besides a fair plan?
So we can insure the separate unit in the back as a tenant-occupied location if it has a separate address.
A DST has no exit strategy. You depend on them totally to exit when they dispose or
Disposition?
Yeah. Sorry about that, guys.
No worries. So we typically tell our investors to expect through the lifetime of the asset 3 to 5 years for single tenant deals, 5 to 7 for multi-tenant deals. There are ways to get out early. Of course, life does happen. Emergency occurs where you need access to the capital. Kingsbarn will do everything in its power to do a 1-for-1 swap, in-house, penalty-free. We raised $500 million last year through California real estate investors alone. So more than likely, if you're trying to come out of one of our deals with $2 million, we'll have another investor looking to come in with $2 million, do a 1-for-1 swap. There's also a secondary market since DSTs have become more popular. The industry's grown where you could sell it for on the secondary market or you could borrow against it. But happy to get into more details later.
Can you safeguard yourself from a DST going bankrupt?
Of course, with any real estate deal, there's inherent risk. If anyone told you that it was 100% guaranteed, I would go run the other way and look for a different investment. How we try to hedge the risk is just by diversification and also by giving you assets to corporate-backed guaranteed leases, as I mentioned with companies such as Tesla, FedEx, Ryerson. You're getting as safe and secure of real estate as you could get, and we have had success through COVID. And throughout our past 35 years, we've never lost a single investor dollar or broken even on a DST sale.
Okay. Another DST question. How liquid are you, and is a DST owner able to readily sell their interest?
I think I kind of touched on that with we expect all our investors to stay through the lifetime of the asset. Again, 3 to 5 years, 5 to 7 years is not really too long of a hold period when you're looking at commercial real estate and investment producing properties. If you're getting your average 6% cash on cash return appreciation, that time goes fairly quick. But there are ways to get out, but expect to stay through the lifetime of the asset.
On the unincorporated rental rate chart, what geographic area covered in 10-unit limit? LA County, statewide?
So for the unincorporated areas that we touched on, those are all the ones for the Los Angeles unincorporated areas. Maybe a bit more, was there a specific question on the unincorporated?
I think the question was whether it's statewide, like can you go all the way up north?
Oh, as far as the portfolio of you
Right.
having, it's every proper, when we checked with the county, they told us it's your portfolio. But I'm not sure if you cross state lines, I don't know if they would find that out. Obviously, they would have to dig into it a little bit. But from the research that we did when we spoke, and my staff spoke, Gianni was the one that spoke with them, they mentioned to us, and we asked in 5 different ways just so that we could get the most acute answer. They said if you own more than 10 units to your name, then you qualify as a general landlord, or 10 or more units. So I hope that answers the question.
And what type of units are those considered? Could single-family homes be considered condos and townhomes? We'll get more into that detail. I feel like the city workers themselves don't really know either. So we kind of have to peel the onion layers on this, but we will get back to you on that. I encourage you to reach out to our office directly and we'd be able to find that out. Is there law governing triple net property tax tenant has paying responsibility? Can the property tax sent directly to the tenant by the tax collector?
Can you repeat that question one more
Yeah,
time?
it looks like it's a triple net property, and it looks like the tenant was billed the tax. So is that the responsibility of the tenant?
If it's written in the lease that way, it's a responsibility of the tenant. We have two, right now we have two triple net leases. One the tenant pays for, one they pay us to pay. So it's basically written on, it applies to how the lease is written.
Okay. If part of a unit got burned, tenants have rental insurance. Can the landlord directly have the tenant claim the renter's insurance without going through the landlord's own insurance policy? There is, again, forgive me for the reading, but I believe there is an arson showing tenant's fault.
So the tenant's liability first has to be determined if the tenant was liable. So, and the coverage for the property is built within the tenant's liability section of the policy. So tenants, when they buy a renter's policy, is usually small amount for their personal property, and then liability most of the time at 100 or 300,000 limit liability towards the landlord. So that's what you'll be claiming against. So your insurance company pays for it, minus deductible, goes after the tenant, and when they do recover, they pay your deductible back.
Okay. Are my insurance rates going to increase because of these Palisades fires? And if so, how much would I be affected even though my own property was not burned?
So it depends on what company you're with. A lot of the insurance companies are looking to get rate increases in California, especially if they've lost money in the fires. But yeah, I would say, I can't pinpoint exactly how much, but most of the companies are looking for a 25 to 35% increase.
25 to 35% increase. Got it. What is the status of AB 246, freezing rent due to the Palisades fire?
What's the question?
It looks like they had a question about maybe this one landlord was concerned about or possibly have heard something about freezing rents and not able to raise them due to the Palisades fire. Is there a law right now in effect? Okay, you're able to raise rents per law?
Yes, there are price gouging laws. It's Penal Code Section 396 that doesn't allow increasing rents, increasing prices for services, including rent, by more than 10%, but other than that, everything stays the same.
Got it. My tenant who was on hospice had her bedridden daughter move into the unit 3 weeks ago. The tenant has now passed away and her daughter wants to stay. However, the building is not handicap accessible. What challenges might I face if I put her on the lease? Is she taking on the responsibility knowing there is no handicap access to the unit?
So the daughter is also handicapped?
It seems to me that the tenant was the one that passed away. Now the daughter is there, and who is handicapped?
Okay, so death of tenants is a very, it's a big issue because you don't want people to inherit an old tenancy. Why? Because rents are low And when a tenant dies and hopefully you get back possession of the unit, you can adjust rent back to market. And that's the whole idea of owning these buildings. So I'm going to just give the general rule about death of tenants. And if you have any follow-up questions, you can come back later. When a tenant dies, the tenancy terminates 30 days after the last payment that was received from the tenant. So if the tenant paid on the first of the month, a week later they died, 30 days after the first of the month, that's when the tenancy terminates. Any occupant that's left in the premises after the death of the tenant, so long as you haven't received rent from them or created a landlord-tenant relationship with that individual, they need to vacate, but they don't. So you need to evict. To know how to evict, call an eviction attorney.
Noted. For a Section 8, 3-day pay or quit, are there any other forms or notices required at the same time? Do Section 8 eviction rules trump local restrictions?
This is a good question because a lot of times when we get new clients, they contact us after they served a notice on a Section 8 tenant, and they say, oh, we served everything and now we want to file the case. We look at the documents and they are not the correct documents. First of all, Section 8 tenants, for non-payment of rent, they get 30 days notice to pay rent or quit. Why? Because during COVID, the Congress passed the CARES Act, which didn't expire. There's no sunset date to it. And that act basically requires a 30-day notice. So the tenant has 30 days to pay or 30 days to quit the premises. In addition, Section 8 tenants are entitled to VAWA protections. VAWA stands for Violence Against Women's Act, even if the tenant is not female. And that's a form of about 10 to 15 pages that must be served with the notice to pay rent or quit. Lastly, Section 8 tenants, when you serve them any notice, not only the pay or quit notices, you must provide copies of the notice and the VAWA forms or any other document that you serve to the Section 8 caseworker. I do it via email and mail. And the HAP contract says at the same time of service. So when you send it out for service, just email and mail the Section 810 caseworker the documents as well.
Are there any 30-year fixed loans for 5-unit apartments?
No.
Noted.
Sorry, no.
And this message is for Kirk. Question, do you specialize in apartment buildings management of shopping centers?
Yes, we do.
Fantastic. What do we do if we can't get any carriers that offer habitability coverage?
Talk to me, I guess.
All right. You heard that, folks. All right. How easy or difficult is it to get out of or sell your DST? And are there various tax implications if you downleg? Is in one state while you upleg DST in another state?
Yeah, so a lot of times we'll work directly with your CPA to see what the tax implications are. And getting out of the DST, I think we kind of covered that as far as doing a one-for-one swap in-house with Kingsbarn and utilizing the secondary market. There are avenues. Is it going to happen overnight? No, but we're going to put a plan in place so that you're able to get out and get the equity that you need to take care of whatever affairs are necessary.
Okay, fantastic. Greg's going to elaborate a little bit more on that.
So California, 1031 is a federal tax code, so you can exchange across state lines. California does have a clawback provision. They've always had it. And it basically says that will allow you to sell a property in the state of California and 1031 exchange into another state and defer the payment of California taxes as well as the federal tax. And it was been in place for a long time. And so people would exchange out of California into states like, Florida and Texas and Tennessee and these states that have 0% capital gains taxes, right? And so they'd hold these assets for a little bit of while, and then they'd sell them, and then if they cashed out, they certainly weren't going back to California saying, hey, I know that you didn't know this, but I sold that property that I exchanged out of California, and I'm here to pay you my taxes. So now California has a filing requirement. So if you sell in the state of California, 1031 exchange in another state, you can still defer the state tax, but you are required to file something with them every year showing that you still own that asset. And if you ever sell it, then California wants you to pay whatever gain that you had made on the property when you were here.
Thank you, Craig. Good old California. If a tenant has damaged vehicle and a carport for over 2 months, does the landlord have a right to tell them to take care of it?
As far as the insurance, maybe, I don't know if that's
Normally, when it's an abandoned vehicle or looks abandoned, we notice the tenant immediately. So we would never let it go 2 months. And what was the last part of that question?
Do they have an obligation, or is it okay if they tell them to take care of it? Like,
we have always told them that it's in the lease that they would have to remove it, but.
And if they don't?
Any kind of difference? No. If they don't do it, then we've moved it.
You've moved it yourself. Okay. Yes. So just stay proactive.
Normally, that's where the tenant has just, because it's a broken car or damaged vehicle, and they left it there hoping they were going to fix it and never did.
Yep.
And so they didn't want to pay to move it, so we would have to incur that cost to move it out of there.
Okay.
Unfortunately.
Okay. What is the eviction laws today about furnished apartments?
There is no difference in eviction laws for furnished or unfurnished apartments.
What should we do if tenant's spouse, kids, including a newborn, moved in, but not on the lease agreement?
So this is a good question, and it depends on where the property is located. At the end of the day, additional occupants require that the landlord be informed and consent to it if that's what the lease agreement states. If you had a single tenant and then they got married, now they have a wife, the expectation is that the wife will apply for tenancy and hopefully will qualify. And if they do, then they get added to the lease. The general rule is that a landlord must not unreasonably withhold consent for additional tenants. If you're in a LA rent control jurisdiction, there are specific guidelines to additional tenants and what you can increase rent up to 10% under a certain set of circumstances. And if you have a specific scenario that you want to run by me, then either reach out to me after this or take my business card.
What happens if one or more of the original tenants moves out? Is the contract still valid?
Yes, the contract is still valid. One tenant departing from the premises, leaving behind another original tenant, does not invalidate the lease.
Can we take money from either if tenant stated that person is paying for them on their behalf?
Well, I don't think that I understand the question, but if there is a third party that wants to pay rent on behalf of a tenant, not only that you can accept it, you must accept it, provided that that third party agrees to sign that by accepting the payment, there is no tenancy that's created. If you don't accept money from a third party, that's discrimination based on the source of income, something that was made up in California, and you can be sued for that.
Is it a good time to refi, or should we wait?
To be technically factual about the previous question about a 30-year mortgage, there's one lender, agency lender, that does provide it, but it comes usually at such a high premium that you need to pay in an interest rate, and generally you're also locked out of that with a pretty heavy defeasance or yield maintenance prepayment penalty for at least 15 years. So that's the factual. And the second question was?
Is it a good time to refi, or should they wait?
That all really depends on an individual's client strategy. If they're willing to, if they need cash out, there are lenders that are treating cash outs just like any, normal refinance. There's no premium and interest rate for that. It depends. A lot of clients we're finding are having interest rates that are adjusting to much higher interest rates, sometimes in the 7, even in the close to 8% range. And nobody wants to pay that high of a mortgage and essentially kill your cash flow. So in situations like that, it would make sense to refinance, and we should explore all the options that are available in the marketplace. And then sometimes, a lot of the transactions we've been doing have been kind of forced refinances where loans are maturing and investors don't really have an option. They have to go back to the marketplace. And that's where we can really provide different options and strategies. There's some no prepayment penalty loans. That's a strategy that's being used very frequently to buy more time and then revisit the marketplace maybe in a better interest rate environment.
Okay. What is the advantage of having my CDs/savings in a trust versus a personal account?
Having your asset inside of a trust, a lot of times the reason you have the trust in there is that if now something happened, the person passes away, that particular asset could be transferred into the trust and it could be distributed amongst the beneficiary. I think the end of the question was, what's the difference if they leave it under their...
If they just leave it in their personal account.
And I'm assuming by that you mean that you don't name anybody as a beneficiary on the account. And if that's the case, if there's no beneficiary named on the account, that means depending on what's the amount of money in that particular account, there might need to be a probate process in order to get that money transferred. Right now, if you have less than $184,500, there's a affidavit that you could fill out. 40 days has to gone by since the person has passed away. You provide a death certificate, you execute the affidavit, and then that fund could be transferred to the heirs. But if it's more than that, then that would require a probate proceeding.
And if they're named as a beneficiary?
If they're named as a beneficiary, so if you name somebody as a beneficiary, then it'll go to that person.
Go to the beneficiary, okay.
The better option is to name the trust, because if you name a beneficiary and that beneficiary has passed away, you're sort of back into the same place. If you already have a trust, a better option is to name the trust, since the trust won't die for many, many years usually.
Is there any trust which allows me to deduct property taxes I pay on my son's property?
If there is a trust that would allow you to deduct property taxes you pay on somebody else's property, no. You gotta own the property in order to be able to deduct anything.
Okay. What about FLPs for Ali?
Family limited partnerships. Did you actually know there is no family limited partnership document in any state to file? It's really just a marketing tool. There's a limited partnership. California has it and many other states have it. There is no family limited partnership, but it's really the same thing. A lot of times we do set family limited partnership for estate tax planning, for asset protection planning. When you place in a property, let's say you place a $20 million property into a LLC or family limited partnership, something happens, you pass away, when IRS goes to calculate to see if there's any estate taxes due, if I own the property under my personal name, it'll be valued at $20 million. If I own the property in an entity like a family limited partnership, there's a good chance that my heirs will be able to receive valuation discount, 10, 20, 30, 40%. So now all of a sudden a $20 million asset could be valued at $14 million or $15 million. So that's why they're used a lot of times.
Will filing claims for damages due to recent wildfire at Altadena will cause the insurance company to refuse to renew me or increase my premium?
If you're in an affected area, there's a state requirement that the insurance companies have to renew you. But if you're not in an affected area and you have damages to file, let's say smoke damage or something that you file against your policy, yeah, they can non-renew you.
Okay. A tenant's son moved to another state, and the tenant allows his friend to replace his son. Living in the property, what should I do? Am I required to allow him to continue living in the property? How do I get him out?
This will go back to the general rule that I mentioned, that a landlord cannot unreasonably withhold consent. So if you had two original tenants, father and son, mother and son, and the son moved to a different state and brought in someone instead of them, you can't unreasonably withhold consent, but they need your consent. So they do need to apply, they do need to seek your approval, and unless you have a good reason to deny it, you need to accept it. And you can have them sign a lease addendum or whatnot, but that's a kind of a one-for-one exchange. That's usually something that landlords should be able to accommodate.
What is a normal property management fee?
It would depend on the property, but it start roughly between 5 to 10%, depending on the unit count and stuff like that.
How do you evict an abusive tenant who is using foul language in a threatening manner and posing in a threatening manner to the landlord?
When you have an abusive tenant, violent tenant, someone who uses profanity, they are a nuisance. Even if you don't have a lease agreement, the law doesn't allow you to just be a nuisance or harbor a nuisance. Pursuant to Civil Code 1161, 4, you can evict for nuisance. The question is going to be, how good is your evidence? So sometimes you have recordings, videos, you have multiple tenants that are complaining against the same person, and sometimes you don't. So what I recommend is, unless the conduct is so egregious that it cannot be tolerable, build up the case. So when a tenant is rude, when a tenant uses profanity, serve them a warning letter, serve them a notice to perform or quit. Tell them that if they continue like this, they will jeopardize their tenancy. If they stop, great, you did your job. If they don't stop, or if they escalate their conduct, then you can escalate the manner to, or the case to a notice to quit, basically telling the tenant, you got an opportunity to stop, you didn't stop, now you need to vacate the premises, and if you don't vacate, we're going to file an eviction against you, we're going to unseal your record and destroy your credit score, and you'll never be able to be a tenant again in California because you have an eviction on your record. I recommend being very aggressive with nuisance, because nuisance is a spreading disease. You allow nuisance in one unit, suddenly another unit is going to be a nuisance. Other people are going to start complaining, and you're just going to have a never-ending headache.
The Glendale laws for buildings built before 1980, can eviction be easier?
Forget about the word easy with evictions. Evictions are hard. Evictions are expensive. Evictions will drain your energy, cause you to go to the doctor. It doesn't matter. We have a case, it's crazy, where we have on camera a tenant at the lobby of the building stabbing another tenant, an older gentleman, stabbing him. He's on the floor. The tenant is stabbing him, punching him. He's in jail, but he does have defense. They've been delaying this case for about 6 months. The victim is, luckily they are alive, but they will not be able to testify. So there are so many hurdles in being able to successfully evict a tenant. There's no such thing as a slam dunk case. Even if you hire us from the very beginning, I'm going to tell you up front, you have a bad case, and you better be ready for bumps along the road, and we're going to be there with you, but you're going to need to pay for it, and you're going to need to kind of be able to accept that sometimes things don't go your way. I don't like to overpromise clients that, oh yeah, we're going to win this case 100%, and you're going to just pay us $2,500 just to lure you in. No, evictions are hard. It doesn't matter where you are. If you're in California, be ready to go to war.
Use your stress ball. Do you have any information on apartment market trends for properties regulated by AB 1482 versus LARSO? I believe West LA specifically.
If there is a specific zip code that you would like us to look up, we could definitely do that. Some of the issues that we have when we're looking up AB 1482 and some of the unincorporated areas, it's a little bit of a cluster problem because the zip codes are mixed. So we could have the same zip code with the boundary right in between, And it's very hard to differentiate it if the above one street is unincorporated and below the other street is AB 1482. When we go to pull the data, it becomes very difficult, and I don't want to guesstimate on the figures, but give us the zip code that you're looking at and we'll do our best to pull the data.
Yes,
we could do it pretty
absolutely.
quickly too, so.
All of the latest regulations, including rent control, unfairly hurts the smaller, older apartment building owners. Is there any attempt to organize a class action lawsuit against these counties for targeting our group?
During COVID, multiple apartment associations, including CAA and AGLA, the Apartment Association of Greater Los Angeles, including also big landlords, filed lawsuits against both the city and the county. Guess how many of those were successful? Zero. Exactly. And not only that, they were unsuccessful after millions of dollars were spent. And I'm saying this not to discourage anyone here from trying to fight for your rights, but rather to emphasize the importance of apartment associations and contributing to their lobbying and legal defense efforts. I may have overspoken saying that nothing was successful. Some of these lawsuits resulted in some changes, but nothing was really dramatic where you're going to say, oh, thank God that I'm in LA County. This is great.
What is the advantages and disadvantages to rent Section 8 tenants, to rent to Section 8 tenants?
Section 8 tenants, you get both spectrums, good ones and bad ones. The benefit to me that since what we've done is we do credit checks, we do a background. We treat them like a normal applicant, and we pick the best ones that we can. The bad ones are bad. They start off good and they stop paying, but lately what we've noticed is if we do these background checks, Section 8 pays a lot higher in rent amounts in some areas.
Got it. If the insurance companies such as State Farm or Farmers refuse to renew, what other options or what is the other best option as far as insurance companies to buy insurance?
So it really depends on the specifics of your property. If the property is older, there's not that much choice. If it's newer, meaning like 1975 and up, there's a lot of admitted carriers, a lot of good companies, very highly rated, and admitted carriers that will take the property.
Okay. Any collection agencies that could help me obtain judgment money and collect the money?
Thank you for that question. Actually, I skipped the part in my presentation to introduce our services. We have multiple sections to our firm. One of them is a collection agency, and we are one, if not the top collection agency for landlords in California. We have on staff around 40 collectors, including attorneys, that all they do is take judgments or even pre-litigation or no judgment debt, and we collect and we report on people's credit history, and we cause them to contact us and pay. The fee is pretty standard. It's very hefty. But the good thing about collection agencies, and specifically us, is that you have zero out of pocket. So we're going to spend money, time, effort into trying and collect on the judgment. But if we're not successful, the cost is absorbed by us.
And if they didn't use your services to win the judgment, could they still use your collection agency?
Yes. You can forward to us a copy of the judgment. And one more comment. There is more debt that's not attached to a judgment than debt that's attached to a judgment. And what do I mean by that? If you have 20 tenants who moved out from your portfolio, you may have 3 tenants that you have a judgment against, but you have 17 tenants that owe you money without you having a judgment against them. And that money can be collected, and that money can ruin a person's credit score. I encourage all of you guys, if you have tenants that owe you money within the last 4 years, to take from your files their security deposit statements and submit them in bulk to your collection services.
Thank you. I sold a home in T-City, used 1031 proceeds, and I put it in a 4-unit I owned previously. The loan company that handled this case at 2.5%, the company then sold the loan at a higher interest rate of 3.25% without my knowledge. What do I do?
So from our understanding, we're not attorneys, but once loan documents are issued, those terms are memorialized until the loan is paid off. Banks do sell notes on the secondary market for premiums and or discounts. It doesn't sound correct, but that's all I can say on that.
I would suggest for this individual to approach one of the panelists at the end, and we can help clarify that for you. If not, we'd be happy to elaborate a little bit more, no problem. What is the difference between California A-credited insurance companies and non-A-credited one? And what is the risk of using a non-A-credited insurance company?
The question is pertaining to non-admitted carriers.
Non-admitted. Yeah.
So the non-admitted carriers tend to take higher risk properties. At that point there, you have to put more exclusions on their policies. And so as far as the admitted or non-admitted doesn't really make the carrier any worse than the admitted ones. They're all, the ones we use at least have a A++ rated AM Best rating. But they do, you have to be careful. You have to use an agent that does understand the non-admitted world, where there could be exclusions that you are not aware of. So just you have to be a lot more careful and know what you're dealing with. The insurance company is really not on your side, obviously.
And this would be our last question, and then we can open the mic up to the floor if there's more questions. Can tenants be evicted when owner wants to sell the units? The city of Montebello, to be exact. Shant is just straight up
That
said
will
no.
depend on the city and whether or not the property is subject to any just cause ordinance. For example, AB 1482 or the Tenant Protection Act of 2019, which is most multi-unit apartment complexes that are subject to. You cannot terminate a tenancy just because you're trying to sell the property. However, if you own a single-family house or a condo, then contact an eviction attorney to see if your specific jurisdiction has a just cause ordinance.
Fantastic. And I'd like to open it up to the floor. If there's a person who'd like to ask a question, I've got one hand up. Let me come over to you.
Yes, you said that you have 4 years to collect past due money. Do you have to get a judgment first?
No.
Thank you.
It's 4 years because the statute of limitation for a breach of contract or a written contract is 4 years. So if your debt is more than 4 years old, you cannot collect. But if it's 2 years old, a collection company can report the debt to a credit bureau and attempt to collect and put a lot of pressure on whoever owes you money.
Yeah, this is a question for the estate planning attorney.
Easy one, huh?
Can you comment a little bit on irrevocable trusts to address the subject of excess amount over the lifetime exemption?
Sure. With estate planning, you really have two types of trust. You have the revocable trust, and then you have the irrevocable trust. The revocable trust, as the grantor, as the person who creates the trust, you have the power to revoke it. You are the beneficiary. You could change beneficiaries, all those things. So now if we're doing estate tax planning, IRS says, well, you know, if you transferred your property in there, just because it's not under your name anymore, That's not enough. We're not going to stop there. If we look at probate, the probate court says if you own the property in a trust, in a revocable trust, that property does not become a probatable asset. So the person passes away, there's no probate, nothing like that. For IRS purposes, for paying estate taxes, IRS says, I don't care that you just put it in this trust. We're going to look to see what powers do you have. And if you have a power to revoke the trust, cancel the trust, do all these things, even though the property was not under your personal name, the fact that you have a trust and you have these powers, we're going to consider that property as part of your estate, and there'll be estate taxes due if the estate is above the exemption. So when we do estate tax planning, the type of trust we use, they're always an irrevocable trust. So we create a trust that IRS cannot come back and say the assets inside of this trust are included in your estate. And that's how you're able to use the exemption. So the exemption right now for 2025 is $13,990,000. They're set to sunset end of this year, January 31st, 2025. And they're supposed to go back to what they used to be, probably around 7 million, unless they get extended again. So now if you have a larger estate, what we want to do is we want to do some estate tax planning. The type of trust we'll have to use will fall under that irrevocable trust. And that's how you're able to use the exemption before they go away. Does that explain?
Yeah. So is there any irrevocable trust that takes care of a step up in basis?
You can definitely have an irrevocable trust and transfer properties in there and still have those property included in your estate. What IRS says, they say you could do planning to eliminate capital gains tax when you pass away, or you could have a trust in place that you would avoid paying estate taxes. And that deciding which way I'm going to set up a plan would really depend on my total estate. If my total estate is $5 million, I don't have an estate tax issue. So it would make no sense to set up a estate tax planning kind of a trust. I want a capital gains tax. I want to avoid capital gains tax. When you get to the irrevocable trust, it becomes a lot more complicated. But the reality of it is you could create an irrevocable trust, and we do a lot of those for asset protection. You might have a $7 million estate. You're not concerned about estate taxes, but you're concerned about asset protection. With irrevocable trust, you could use it for estate tax planning, but you could use it for asset protection planning. But I want it to be the kind of trust that even though it's irrevocable, the assets I place in there will still be considered part of my asset, because if that's the case, and when I pass away, that particular property will get a step up in basis.
Thank you.
You got it.
I've got one more question here on this side.
As far as the LA County, the unincorporated LA County, property owners are now required to register their properties and pay a fee and report the rents and any rent increases or any changes in the property. I felt myself rather frustrated with that. And I'm just wondering, is anybody opposing that or fighting it? Or do you see any privacy issues with regard to that? Or is there anything I can...
I hear about that quite a bit. It's definitely an overreach, but obviously they're doing it for, part of the reason is the per unit fee that you're going to pay every year, which I believe is around $90 or so.
Right.
Which 50% of it you can charge back to the tenants
Yes.
on a monthly basis of
Yes.
a few dollars every month.
But other than that, you don't see any privacy issues here that the landlords
There are, but we have to understand, the LA County Board of Supervisors is probably one of the most liberal boards you can go against. Everything for them is tenant-based. The landlord is the enemy. So from all of the different ones, from all of the different jurisdictions you could be in, the LA County Board of Supervisors, based on the experience that I've had, tracking them over the course of the years, you're not really going to get anywhere. It's going to give you more frustration than results, unfortunately. So.
Yeah, okay, well, as far as I'm concerned, this is the last time I buy or invest in a property in the unincorporated LA County. So,
It's certainly frustrating indeed, but definitely do pass that. You do have the option of passing that fee, 50% of it, to the tenant. So I would 100% take advantage of that. I've got one more question over here.
Yes, this question is for Mr. Nadav. On February 27th, I received an email from the California Apartment Association asking me to call my legislators to vote no on AB 247 rent freeze. I believed earlier you said that there was no rent freeze for LA County presently in effect, but the email says that the Assembly Judiciary Committee was going to vote on it on March 4th, which was a couple days ago. Do you know what happened?
It got pushed to tomorrow. They postponed it till tomorrow.
Okay. All right, thank you.
I've got one question on this side.
My question is for the attorney, and it happens that I have one tenant that is very aggressive as well as very disrespectful, and now I tolerate these years, but now my son needs an apartment, so I want to ask him to vacate, but I know that is going to be an issue. So what is the best way to approach this with the tenant?
So owners have, for the most part, have the right to terminate a tenancy for owner or family relative move-in, but it depends on where the property is, what set of laws the property is subject to, and who your tenant is. I'm happy to discuss your personal situation after we're done.
Okay, thank you.
This is regarding tenant screening in Glendora. So far, my practice has been that when someone's interested in a property, I'll go to the TransUnion website and send the tenant a link to apply, and they pay. I don't charge for my time and my overhead, but they pay the fee directly to TransUnion for SmartMove. My thinking is that's transparent, at least. Is there any advantage, though, to my paying, and also I don't have to worry about bad checks, but are there any advantages to my charging a fee to the tenant and then my potentially paying TransUnion or some other service directly?
I think that the service that you described that you're using is probably a better service to handle, and I would continue with that until at least you know what other alternatives you have. But if you have a go-to vendor that does it A to Z for you and there's no money coming to you, I think that's better.
Okay, so it's simplest if I keep myself out of those transactions. Yes. Okay.
I have a property that was affected by the Eden fire on Altadena Drive, and one of the units was partially damaged. That is, the stairs and the outside were damaged, and the unit inside mostly damaged by smoke. And what I've done is I've given each tenant some reimbursement, some funds for their cleaning. Now, one particular tenant, the one that was most affected, was insisting that I pay separately to have her unit cleaned. Am I legally required to do this after having paid for that purpose?
So you paid for cleaning and now they want additional cleaning?
Yes, they apparently didn't use the money for cleaning. They may have used it for something else. And now they're saying I'm legally responsible to having me personally or contract a cleaning company to clean it.
If you documented your initial payment properly, then I don't think anyone would expect for a landlord to pay twice for the same thing. I personally recommend not to put the tenant in charge of any maintenance or cleaning. I would, for the next time, in a perfect world, I would expect a landlord to hire the cleaning company and to pay them directly and to monitor their work, rather than giving it to a tenant who may not be the most responsible person, and you never know, maybe you gave her $300 and she needed medicine that day. So that would avoid the situation.
I'd like to speak to you afterwards about this particular
Sure.
situation.
I've got room for 2 more questions. Unfortunately, we've missed our mark. I'd love to be here all day with you guys, but I'm going to make room for 2 more.
On the rental agreement, rent is due on the first of the month. Can we collect late fee and our tenant pays the rent by U.S. mail?
The short answer to the late fees is yes, you can collect late fees if it's part of the lease agreement. And if you receive it by mail, you're probably not receiving it on the first unless they pay ahead of time. But if it's postmarked the first or prior to the first, I would accept this as not late.
Okay.
And also, courts don't like late fees. So if a tenant is 2 or 3 days late one time, I wouldn't make an issue of it because you want to have a good relationship with the tenant.
Of course.
But if someone is ritually late,
Yes.
Then you have the right to charge late fee if it's part of the lease agreement.
Okay. And what percentage are we talking about, late fee-wise?
There's no specific percentage.
Okay.
You need to be able to articulate in your lease agreement
Okay.
how you got to whatever it is that you want to charge.
Okay, good. Annual fire inspection, is this going on all over LA area? I mean, every year, for the last 2 years in Montebello, there's these annual fire inspections.
It's great that you asked that question because we've got charged that as well. So what they did was, theoretically, that should be part of the taxes that you pay. But what's happened is they've contracted a third party account or a third party company. If you go to the company's their website page, they will tell you, please get us on board with your city, and we will go ahead and we will increase your revenue by a great amount. My wife she can attest to this.
I love them.
Yeah, we fought. So we got charged on an inspection that was forged with our signature, where we never allowed anybody inside that building. In my opinion, I've spoken with a few people about it. That company doesn't even have a business license to do business in Montebello, which is what you need to have. But ultimately, I don't know if you want to go to war with them. It's not a huge fee, but it's the principle of it, which I understand. So I know people that have not paid it, but I think we just paid
We fought the first year because they forged our signature. They said that we fire inspected your property and you're missing A, B, and C. Pay us $150 and fix the 3 problems. I looked at the inspection report and I said, well, whose signature is this? And they said, yours. And I said, no, it's not.
And the building that we have is completely secure.
Yeah,
you
you
cannot
can't
get
go
anywhere
into
near
it.
It's completely locked.
So it was bogus. They never inspected it, and I raised a few concerns, and they actually, after that, send an inspector to our building to inspect. They found out that there are no issues with it, and I still paid the $150 and kind of put it to rest. Yeah. So unfortunately, it is something that should have been covered within your taxes, but now they've contracted and outsourced it, and they're billed separately.
This is going on with a lot of other cities
Yeah.
as well. There's all these type of money grabs. We take $120 here, $120 there. There's 381 buildings in that city over 5 units. So you take $129 from every building for an infinite amount of time, and you've created revenue. And the opposition, for the most part, is extremely minimal. Majority of people, they just go, oh, it's the fire department.
Yeah.
They put a nice stamp on it and they send over the check. So, yeah, that's what we're at.
We have our last and final question for this afternoon.
Let me add on to that fire inspection. I was told by that company it's a federal law. So all jurisdictions are going to be basically assess this fee, and they have to go in and inspect. So it's a federal thing from what I was told. But I didn't know that they didn't have a Montebello license. Anyways, my question is, there's a lot of advertisement going on as far as spraying your roof instead of having to replace the roof. Would that fly with insurance companies? Because I'm thinking of doing it on one.
What do you mean spraying the roof?
Oh God, there's so much advertising. Instead of replacing a roof, they spray this chemical or something on it that basically seals it and renews it. And yeah,
And
it's all over.
Whoever does that gives you some kind of a warranty for some time or no?
I don't know. I haven't contacted them, but it looks really 10 years. 10 years.
Yeah, as long as you have a warranty paper, the insurance company will take it.
Okay, perfect. Thank you.
Well, that concludes our afternoon, everybody. Thank you all so much for sticking around, hearing us. We really appreciate the feedback. If you can, take some moment and take some time to fill that out. Other than that, enjoy a beautiful rest of the day, and we really appreciate you. Thank you, thank you. Take care.